All right, welcome to, today is Tuesday, August 20th. This is our final day of class. Today is presentation day, and we have a lot of presentations to get through. So the plan is, I posted an announcement earlier listing the order of the presentations. Ford will be kicking us off, and also your assigned investment committee. So Ford is team 2, team 3, you'll be the investment committee for Ford, etc. And so check that on the announcements if you want to keep track. So basically each team will have 20 minutes. I'll put you on a timer to keep track when you start your presentations. When you get to 20 minutes, I'll ask you to wrap up. And, if you're not done, maybe another 10 or 15 seconds, just because we have to get through all 7 teams tonight. And then approximately 5 minutes for the investment committee to ask their Q&A. Okay. So given that we need to get through that today, any questions before we jump in? All right, Ford team, are you ready? All right, if you guys are ready, I'm going to start the clock on our first presentation.
All right, everybody. This is our Ford valuation analysis. Considering the current share price of 10.14, we think Ford is a sell with our target price at 7.94. So getting into the economic portion of the EIC analysis, some key factors playing into the whole economy. We have rising interest rates. Current Fed rate is between 5.525 and 5.5, making credit and financing very difficult for most buyers. Then we have elevated levels of inflation across the board, which has made consumers a little bit more wary, and they're delaying certain major purchases, which has affected the auto industry, which we'll take a look at. There's also rising tensions in Asia, which has placed tremendous uncertainty on supply chains, and that has affected particularly companies that are very reliant on technology. Then looking at the industry, we see that the industry spread that ROIC versus WACC is negative 1.51. That means the automotive industry is not attractive. The cost of investment outweighs the return on investment. We think a lot of this is associated with the contraction in sales after COVID-19. There was a big boom, and now it's contracting back to somewhat normal rates. We also see EVs kind of shaking up the legacy automakers. The EV industry is largely dominated by new entrants, which has forced legacy automakers to kind of catch up. In terms of a 5-year outlook, we see the industry normalizing or resetting to a pre-COVID standpoint in terms of sales. And then there's a really heavy reliance on controlling inflation so that buyers are not shied away from making purchases. We can look at a little bit more in depth with the 5 forces breakdown. We see strong power for suppliers. There's often lengthy contracts and large inventory quotas that need to be upheld, which gives suppliers a lot of negotiation leverage. Buyers is weak to moderate, and then we think it's going to transition to weak as there's many buyers and not very many auto manufacturers by comparison. There's also not much development of urban planning and public transportation in the United States. So we think as population grows, their power will weaken. In terms of new entrants, right now it's relatively weak, but we've seen recently within the past couple of years, and we think more so in the next 5 years, smaller manufacturers coming into play and trying to break into the EV market, which we've already seen with Rivian and Lucid and obviously Tesla operating outside of what is normally the business model for an auto manufacturer and operating more like a tech startup. Then we look at the substitutes. We see a lot of pressure from the ride-sharing services, where one person is now servicing many different individuals, and those many different individuals no longer need to purchase a vehicle. Then we see pretty much steady competitive rivalry. We had some consolidation from the legacy automakers absorbing smaller brands, but then a reintroduction of smaller brands when the EV boom took place within the past decade. Then looking at Ford, Ford's spread is worse than the industry at negative 3.57. Obviously, we do not think they have a competitive advantage. We don't think they will in the next 5 years. While Ford is a legacy automaker and they have strong relationships and established supply chains, they have been very slow to compete in the EV market. And the EV market has pretty obviously become the determining factor in whether an auto manufacturer is going to be at the top of the food chain moving forward. In terms of a 5-year look, we're looking at Ford needing to become competitive in the EV market. They made room in their lineup. They removed some non-performance and non-truck gasoline vehicles to make space for these EV vehicles, but they haven't had a model gain traction in the market yet. We're moving on to ROIC.
All right, moving on with the ROIC tree analysis, starting on the left side of the tree. In 2019, Ford started with a negative 0.1% end of year ROIC, and 5 years later, they improved to a 7.9%. And as you can see, most of that improvement came between 2020 and 2021. Now looking at the level 1 drivers for the cash tax rate, Ford's tax rate was extremely volatile over the 5-year period. So we had to look at Ford's income statement to get some more insight on the taxes. And we found that they were given tax refunds in 2019, 21, 22, and 23. And for example, like in 2019, we can see that there was a 113% tax rate, but there's more to that. There was a $724 million benefit resulting there, arising from a restructuring with their European operations. But nevertheless, the lower the tax rate helped contributed to the higher ROIC. Next, we look at the operating margin. They started with a margin of 0.004 in 2018 and increased to $0.031 in 2023. So looking deeper at the level 2 main drivers of operating margin, we can see that depreciation decreased 19.9% over the 5-year period, starting with $0.054 in 2019 to $0.044 in 2023. SG&A expenses decreased 15.2% and gross margin increased 4.3%. Invested capital over sales, otherwise known as productivity, increased over the 5-year period. Invested capital to sales went from $0.485 in 2019 down to $0.426 in 2023, causing a 12.2% decrease. This was mainly driven by the 23.5% decrease in operating working capital over sales. Ford went from $0.248 in 2019 to $0.19 in 2023. Meanwhile, PP&E and goodwill did not have much of an impact on productivity because it stayed relatively constant over that 5-year period. Next slide.
Okay, now we'll look at Ford's free cash flow analysis over a 5-year period. Over the 5 years, Ford had $13.286 billion in free cash flow and generated $48.471 billion in gross cash. Ford also reinvested $34.864 billion, and most of that was in capital expenditures, making it a 72% reinvestment rate. Ford's largest acquisition was in 2021 for $328 million. And with this, they purchased Electrify, and this is to provide Ford with pro commercial customers with seamless charging and energy management. Ford additionally wants a piece in the electric car market, and they're making a plan to invest in the technology. Moving on, they had net operating gains of $13.264 billion and a decrease in non-operating assets of $2.76 billion. This left them with $25 billion to be paid out to investors. $5.886 billion was paid out in interest and decreased their debt by $3.1 billion. They borrowed a bunch of debt in 2023 in the amount of $10.633 billion and paid out $10.392 billion in dividends, but repurchased about 1.1 billion shares, essentially $11 billion payout to their shareholders. Ford was able to do this while paying back debt because they started with $25 billion in CFI. Ford paid back around $23 billion worth of debt in 2021 and bought back a large quantity in bonds issued at the start of the COVID pandemic. Paying back this debt will help finance their vision of investing heavily in the electric car market. Next slide.
Looking at the industry multiples, we'll start with PE. So all across the board, all three companies trade at pretty steep discounts to the rest of the market, PEs ranging from 3 to 5. Ford is trading at a slight premium to its competitors, 5.19 for Ford versus GE at 4.39 and Stellantis at 3.07. Given the uncertain futures and some of the turmoil in the auto industry, we had to get pretty creative to determine appropriate growth rates for each company. We took the growth rate for Ford from our DCF as is model. On the Stellantis side, the growth was determined by forecast net income growth in 2027 from Bloomberg data, and GM's growth rate was backed out from ROE. So GM is growing at a pretty similar rate to the rest of the US economy, 3.27, so roughly tracking along with mature US GDP rates. Stellantis and Ford are trading at a fairly stagnant growth rate of 1.52 and 1.43 respectively. So really stalling the rest of the market. So we solved for each company's ROE and found all of them to be fairly low returns, led by GM at 5.31 and followed by Ford at 3.2 and Stellantis at 2.13. The low ROE values give way to highly negative spreads, with Ford trading at the lowest of negative 8.9%, followed by Stellantis at negative 8.67% and GM at negative 6.69%. So all three companies destroying value at a fairly rapid rate for the current time period. Overall, Ford is essentially trading at a premium to Stellantis, but only due to its lower growth rate with a fairly comparable spread, and a premium to GM only due to its significantly lower growth rate despite the more negative spread. On to EV to EBIT. So GM is trading at a premium multiple of 3.56 compared to 3.28 of Ford and Stellantis at 1.75. Again, we got to a pretty similar growth rate by using the Ford value from our DCF as is, and then solving for the GM and STL growth rates as we've done in class. GM's trading at the largest growth rate again at 3.27, followed by Ford at 1.43 and Stellantis at 1.13. Each company has a pretty similar tax rate. Ford's at 22.7 versus GM at 20.5% and Stellantis at 19.6%. So not a real driver in the difference of tax rate. We solved for the ROIC value of 1.79 for Ford and unlevered the ROEs for both GM and Stellantis, finding GM at 3.93% ROIC and Stellantis at 1.35% ROIC. So similar to ROE, pretty low returns. With that, all three companies are trading at a negative ROIC to WACC spread again, with Stellantis leading the way at negative 7.15%, followed by Ford at negative 4.41% and GM at negative 3.07%. So again, looking at ROIC, we're destroying value rather quickly. The WACC indicates that Stellantis is a slightly higher risk company at 8.5% when compared to GM at 7% and Ford at 6.27%. So essentially, GM is only trading at a slight premium to the other two due to their significantly lower negative ROIC to WACC spread. On to EV to sales. So GM's trading at a premium of EV to sales of 0.26 compared to Ford at 0.2 and Stellantis at 0.17. So all are fairly close in this category. Stellantis is actually trading at a premium op margin of 9.7% and NOPAT margin of 7.8%. This compares to the 7.3% and 5.8% of GM, while Ford kind of brings up the rear at 6.1% operating margin at 4.7% NOPAT margin. Given that Stellantis is leading in the margin, they actually have the lowest multiple due to their staggering productivity number. So they're at 5.79 when compared to Ford at 2.63 and GM at 1.48. The number suggests that Ford or Stellantis actually has to invest twice as much as Ford to generate the same sales. And again, the negative spreads still play a role here, with Stellantis having the most negative spread, being the reason that they have the lowest EV to sales ratio. Next slide.
So before we dive into the DCF analysis of Ford, we're going to look at the as-is model, or the base case, given the current share price of $10.14, as well as the consensus estimates and the assumptions needed to achieve that valuation. So with that in mind, we've set the WACC, as it was mentioned prior, to 6.2% based on the Bloomberg market data, as well as input the consensus revenue and EBITDA estimates for the next 5 years. Ford, as it's been mentioned already, was a bit tricky due to the state of the industry, and we found that solving for the long-term growth rate actually yielded something very unreasonable. So what we did instead is we used the long-term growth rate from Bloomberg and solved for the 2029 EBIT margin. We feel that this is because the market doesn't actually expect the EBIT margin to be 6%, as shown here. And we'll discuss that on the next slide. So you can see here the important feature to call out again is just the historical data of Ford being pretty inconsistent from year to year. As it was already mentioned, the revenue and its tax rate, both have fluctuated, making it a bit challenging to create an accurate model used to forecast into the future. As it was mentioned, you see a tax rate going from 113 down to a negative 14. And again, this is just a matter of the quirks with the data, which was again explained earlier. So with that in mind, we assumed a 1% growth rate in revenue for 2029, as well as an EBITDA margin of 7.4%. We then arrived at that 3% EBIT margin mentioned earlier, which is in line with historical performance in 2023. We also assumed that 22.7% tax rate from the JP Morgan estimate analyst report, and then we kept the remaining metrics the same. And from here, we built the bull, bear, and target case. Next slide. Yep.
So for Ford's bull model, we calculated a estimated share price of $11.81. To reach the share price, we first assumed a 2029 revenue growth rate of 2%, which is rather conservative, but it's higher than the automotive industry's annual growth rate of 1.6%. We also changed the tax rate to 22% from 2025 onward to reflect a positive change in economic policy from the upcoming election. For the terminal growth rate, we also increased that to 2.75%, assuming Ford is able to successfully capture some market share within the EV market, which is growing at a rapid rate of 8.9% annually. We can see this happening because they are currently in the works to produce more affordable models to attract a wider consumer market. For the 2029 EBITDA margin, we increased that to a 7.7%, as they are focusing on increasing their EV production efficiencies, and they will capitalize on their professional segment, which has a rather high margin. And inversely, we'll move on to the bear model, which shows us negative conditions. For the bear model, we reached a share price of $7.39. The first assumption we made was for the 2029 revenue growth rate, we assumed a negative 1.5% as they continue to struggle with revenue volatility. As for their tax rate, we increased that to 28% from 2025 onward, considering non-favorable economic policy from the upcoming election. And this is also one of the assumptions that the JP Morgan article made for their 2025 year. In this case, Ford will experience a negative 1% terminal growth rate as they fail to capture significant EV market share. They currently hold 6.3% of the market, falling well behind Tesla and Toyota, and they do not have a good outlook for future models compared to GM and Stellantis. Finally, we see their 2029 EBITDA margin fall to 6.7% due to high production costs from union pressures and also many consumers growing price sensitive. Next slide.
All right, now we'll look at our target model. So we were relatively bearish on our target model. We calculated target share price for Ford of $7.94. So we made some key changes from our as-is model to reach this value. Notably, the biggest change was the EBITDA margin. We reduced from 7.4% to 7.2%. This was decreased, as Blake mentioned, to reflect increased production costs. Additionally, we increased our tax rate to 28% from 25 onwards as a reflection of a change in presidency in which Kamala Harris wins the election. Then we changed our 2029 revenue growth rate from 1% to 0% as we're relatively bearish on their outlook. This wouldn't have the largest impact on share price, but we did also reduce their terminal growth rate to 1.25% from 1.42%, as we expect Ford to continue struggling long-term in the EV industry. So now our recommendation on the next slide, as we previously mentioned, is we recommend Ford as a sell. So our target share price of $7.94 compared to the observed share price of $10.14 yields a difference of negative 21.73%. And therefore, we would recommend Ford as a sell for any investors. Any questions?
All right, thank you, Ford team, for leading us off. That was well done. Team 3, you're the investment committee. Your time for questions, 5 minutes.
Hey
I had
guys,
oh, go ahead, Lucas.
go ahead, Sarah.
No, I honestly actually had a question, and it might be more for something, a clarifying question from Teddy. The slide on the PE multiple, do you mind going back to that really quick? I thought in your voiceover you had mentioned the PE multiple was like lower. Did you say it was like lower than the industry PE, or I wasn't sure if I just misheard. And maybe this is a silly question, but I just wanted to ask anyway.
Just referencing the market overall. So PE values kind of, 3 to 5, while tech companies are trading 20 to 30. So I think it's more just indicative of a poor industry to invest in with a lower multiple.
Okay, got it. I didn't know if you said the industry, and I was just curious to know then what the like industry, I guess, if there was like an industry PE or something that you were like comparing it to. So
No, we
Good to
didn't compare it
just the market.
Yeah.
Got it. Okay, thank you.
I have 2 questions for you guys. I think when you were going over the EIC, may have missed it, but I seem to remember the market sensitivity, the industry sensitivity to the market, but how does Ford compare to the industry in that sense, sensitivity?
I think we're going, this one. So I can actually handle this. So Ford, so the automotive industry as a whole is actually more sensitive than the market to economic change. So the auto industry, when the S&P moves 1%, the auto industry is going to move 1.3%. Now Ford, on top of that, is actually more volatile than that. So Ford has a beta of 1.7 and is going to move 1.57. So Ford will move 1.57 times the S&P expected. So Ford is more volatile and is a riskier company than the industry as a whole and the market as a whole.
Thank you. The other question I had was just on the target tax rate. I saw that you guys raised that quite a bit based on this upcoming election. Would you think that one election would affect the perpetuity rate so drastically, or would we see a little more tepid change?
So historically, taxes have always been pretty much higher than where they are now. So I think that using a 22% tax rate in perpetuity would be relatively aggressive anyways, regardless of the outcome of the election. So it would impact, 25 through 28, but I think long term that tax rate of 28 is probably more reflective of what we should expect taxes long term.
I think that's pretty reasonable. You guys did a really good job.
Thank you.
I guess last I just have one question. I guess it's not too much really based on the model, but so Ford stock over the past 10 years, I think it's gone up 0.77%. So it really hasn't moved at all since 2014. It's been pretty maybe up and down 1% here and there. but it doesn't really change that much. Do you think in the next like 5 years that's gonna change, or are you just saying this is what the current value you think is? So I do agree. I think Ford is kind of a piece of crap, but do you think investors will have that same sentiment? Because it's been just like a straight line, which is the opposite of what we want to see from a stock, but at least it's not going down a lot.
Well, during that time frame you just mentioned, it's relatively recent that EVs have taken over. So it may not have moved over the time
That's
frame
true.
you mentioned, but in recent years, EVs have become the craze, and Ford has really struggled to get into that market. They saw limited success in that, and they've actually been kind of pulling away from or shying away from fully entering the EV market. So I think that based off of their performance in EV, we actually can see a decline in Ford price, contrary to how their performance has held steady in the past.
Yeah, that makes a lot of sense. Thank you. Really good answer.
I guess one other question, for the tax rate, like I know you were doing that to reflect Kamala Harris's presidency. And I guess I was curious to know if you guys considered if Trump ended up taking over and like how that would affect the target model.
So that was actually our bear model.
Oh, I'm silly. I didn't see that. Okay, got it.
That was our bear model.
Okay.
We assumed
So the target though, you're expecting Kamala, I just wasn't sure
correct.
in terms of okay, got it.
All right. Good job, Ford. Good job, Team 3. Way to kind of set the tone for everybody. So that we'll be on time. By the way, just as a side note, Ford, you had one of the more challenging companies to do, given everything you did on the modeling. So overall, given the challenges, really good job. So thank you for leading us off. Let's go to our second team, Lululemon.
Yeah, I can share my screen.
All right, so Ford, if you want to take your screen sharing off.
Travis.
I'm not sure who's sharing, but if you can stop your sharing. Ford. Tell you what.
I think he disconnected because his
screen went black. Yeah.
All right, so I'm gonna, let's see. I think that kicked him off. All right, Lulu, you ready?
Yep. Let me share this screen.
All right, I can see your screen. I'm gonna start the 20-minute timer.
Okay. Hi, everyone. We are Team 3, and we will be giving you an analysis on Lululemon, which we gave a hold rating and a target price of $265.04. Next slide. So based on Bloomberg, Lululemon is indeed sensitive to economic shifts as evidenced by its raw beta of 1.26, which surpassed their industry average of 1.18. This suggests the company is more responsive to market changes, and this elevated beta underscores the likelihood that Lululemon's stock price will experience more pronounced movements in response to economic conditions. In terms of the industry, IBISWorld Industry Report had also mentioned that revenue volatility is high in the industry, which indicates sensitivity to economic changes. This makes sense as economic shifts impact consumer confidence and disposable income. Next slide. Our next big focus was to do an industry analysis using the relative value screenshot we were provided, which showed an industry ROIC of 15.02%. This is higher than the industry WACC of 9.45%, showing that the industry is able to generate returns that more than cover their cost of capital. This indicates the industry is attractive as a spread and NPV are positive. Next slide. Our information to make the evaluation seen in this table primarily came from the athleisure clothing industry report from IBISWorld. For competition, which was rated high, it was stated that there is significant competition from foreign companies that are harming domestic sales, thereby creating a way for international organizations to penetrate the US market. Some of the competitors highlighted in Lululemon's 2023 annual report acknowledged Nike, Adidas, and Puma, as well as Victoria's Secret as some of their competitors. In the future, we don't expect competition to decline, especially from foreign producers. It was mentioned in IBIS that lower operating costs overseas will make it possible for these producers to offer lower prices, which will boost competition. Currently, the threat of new entrants can be considered moderate, even though developing new quality products and materials can require significant capital. It's noted that consumers like to have options for different brands and different styles, attracting new companies that will enter the industry. The threat of new entrants in the coming years, however, is likely to decrease as companies such as Lululemon will enhance their social media and online presence, but will also leverage machine learning to improve processes, which will be emerging within the industry, meaning more investments to technology are going to be necessary for new entrants if they want to compete. Substitutes was given a high rating as there are currently plenty of companies that are producing athleisure apparel as it increased in popularity since COVID. Consumers are currently able to go to different stores to find similar products within the athleisure wear category, which we don't see as changing in the next 5 years. There's been a rise in popularity of yoga and Pilates demand from women, and participation in sports has been rising for men. In terms of supplier powers, companies such as Lululemon relied heavily on using specific quality materials that was only offered from select companies. In recent years, however, fabric and materials within the athleisure wear industry have been able to expand their list of potential suppliers due to the increase in demand. This resulted in a moderate rating for the industry at this time, and the cotton industry, which had undergone volatility in recent years, is expected to also stabilize, suggesting supplier power can be moderate. Buyer power currently has a moderate to high rating as amount of substitutes within the industry, and the low amount of switching costs gives buyers more power to choose which products and brands they prefer. IBIS World mentioned that improving economic conditions are expected to continue driving growth within this industry. So combining this with price competition due to foreign competitors, buyer power will increase. Next slide. Currently, Lulu is seen to have a competitive advantage in the market since its spread of 19.16 is significantly higher than the industry spread of 5.57. This also indicates its status as a premium company within the industry. This can be due to their expansion efforts internationally. Their offering of membership programs that include early access to products, community experiences, and free hemming help the company differentiate themselves from its competitors. With Lululemon's recent partnership with Peloton and their focus on the power of 3x2 strategy, which targets further investments and expansion within men's, digital, and international areas, we expect Lululemon to sustain its competitive advantage in 5 years. Next slide.
So here we have the last 5 years historic ROIC analysis for Lululemon. The change in end of the year ROIC increased quite substantially from 2020 to 2024 with some fluctuation, increase from 37.9% to 43.9%, which is a 15.8% improvement with goodwill, and from 38.5% to 44.2%, a 14.9% improvement without. The overall tax rate increased slightly from 28.1% to about 28.8%. 2.5% increase from 2020. More importantly, an increase of 16.9% in the pre-tax ROIC from 52.7% to 61.6% with goodwill, and from 53.4% to 62%, a 16% increase without, are driven by the reduction in invested capital to sales from 42.4 cents to about 36 cents, which is a 15.1% decrease with goodwill, and from 41.8 cents to 38.5 cents, a 14.5% decrease without. The operating margin remained unremarkable overall at around 22 cents, even though the SG&A expense increased by 7.8% from 33.5 cents to 36.1 cents. It is offset by the decrease in depreciation costs by 3.1% from about 4.1 cents to about 3.9 cents, and the increase of gross margin by 3.9% from 59.9 cents to 62 cents. In both cases, the combination result of reduced operating working capital from 7.6 cents to 6.5 cents, a 14.1% decrease, and a reduction in PPE to sales by 14.6% from 34.2 cents to about 29.2 cents, significantly drove the reduction in invested capital as stated, which ultimately improved the overall ROIC. In addition, the reduction of intangible costs from about 0.6 cents to 0.3 cents, which is a 59.2% decrease, contributed to a slightly higher end of the year ROIC with goodwill than without. Next slide, please. So the raw trend remained positive for Lululemon as shown by the ROIC tree. However, with goodwill, there was a rapid decline phase from 2020 to 2023 before rebounding in 2024. The decline possibly reflected a combination of lower operating margins, higher tax rates, and less efficient use of capital. The recovery in 2024 is supported by an improvement in those key areas, particularly the operating margin and capital efficiency. As you can see, the similar trend is observed when excluding goodwill, with ROIC declining from 2020 to 2023, then rising back up in 2024. So moving forward, shareholders and potential investors should remain optimistic about the future growth of this company. Next slide, please. So overall, the key driver for Lululemon's improved ROIC is the reduction of invested capital per sales. The significant decrease of about 15% indicates that the company has focused on improving capital efficiency, reducing overhead costs while being consistently productive in generating sales, which are further driven by decreased operating working capitals to sales, PPE, and intangible costs. A remarkable decrease in working capital for the last 2 years suggests a drastic change in inventory turnover, greater efficiency, and optimizing resource management. PPE and intangible asset also got better as both decreased over the period, indicating more efficient use of fixed assets and to generate sales and utilizing its intangible assets. Next slide, please.
Okay, so I'm going to go over the CFI here. And through our analysis, we took the gross cash flow. We've seen that it steadily increased over the 5-year period, starting around $800 million in 2020 to growing to nearly $2 billion in 2024. This reflects, an increase in operational efficiency and profitability, generating more cash year over year, and provides the company with more internal funds to support operations, reinvest in business, and return capital to shareholders. When we look at the free cash flow, we started with negative values in 2020 and in 2021, but we started seeing positive values in 2022 and 2024. In 2023, there was a sharp decline. In these years, when they were either a decline or a negative, we would suggest that Lulu was heavily in the growth phase, and while consume more cash and try to generate from operations, Lulu threw in the towel on a investment called Mir, which was a kind of a Bosch at home workout system, and that's where you see these drops. So if you look at the reinvestment rate, investment rate was a key driver. The free cash flow started very high in 143% in 2020, and then decreased all the way to 37% in 2024 with a slight jump in 2023. The initial high reinvestment rates indicate more aggressive expansion or investment assets to drive kind of future growth. And the reduction to show that Lulu has begun to kind of reach more of a stable growth phase, requiring less capital to maintain its growth objective. When we look at the debt, we can see that obviously the company has continued to be increasing their debt with significant borrowings in 2020 and 2023, and especially in 2024. The increase in debt suggests Lulu is funding its growth and strategic initiatives, and as well as share repurchases. Going to the equity phase of it, the share repurchases, we can see that we see significant repurchases in 2022 and 2024. And as there's no dividends being paid, the company is prioritizing share repurchasing as a method of returning capital to shareholders. So when we look at the CFI altogether, we've seen that the CFI has been positive for most years. We saw a significant spike in 2022, reflecting the company's strong free cash flow in the year, remaining positive through 2024. This implication obviously is covering all their operational and capital expenses. The company has consistently generated cash available to return to its investors. So our conclusion is over the 5-year period, we see growth in operational capital leading to improvements in free cash flow, particularly in the initial years of reinvestment. The company's strategy is returning capital to shareholders through its repurchasing and leveraging for long-term growth. The reduced reinvestment rate and improved FCF suggests that Lulu is transitioning kind of more of a phase of more stable growth, strong operational cash flows, and optimizing its capital structure.
For our multiples valuation, the two comparable competitors that we chose are Nike and Adidas. Lululemon's price per earning ratio is at 15.65, which is lower than both Nike's 21.84 and Adidas' 19.87. This indicates that Lululemon is trading at a discount relative to its peers. With the lower PE suggests that the market may have some concerns about the sustainability of Lululemon's earnings given its risk profile. The expected net income growth is calculated at 5.76%, slightly lower than Nike's 6.08% and Adidas' 10.51%. The lower growth expectations typically result in lower PE multiple given the positive spread of all three companies. Investors may anticipate slower future earning growth. Expected ROE of 32.1% is lower than Nike's 36.67% and is above Adidas' 27.23%, which typically warrant a higher PE multiple than Adidas, but hurts them in comparison to Nike. Lululemon has a higher cost of equity at 11% compared to Nike's 9.9%, but lower than Adidas' 13.6%. The higher risk increase the discount rate applied to future earnings, lowering the present value of those earnings and thus the PE multiple. Next slide.
Going into the EV over EBIT, I think this is a lot more valuable ratio than the PE, just because PE is subject to manipulation and doesn't factor into debt. But if we're just starting off at the top here, we can see Lulu clears Nike and Adidas in terms of their operating margin. And just looking at this operating margin alone, you can tell that Lulu is a premium brand and demands premium price. They're had 10.47 above Nike and 12.58 above Adidas. And their NOPAT margin tells a similar story, where they're 5.75 above Nike and 8.3 above Adidas. But the first area where Lulu falls behind is their productivity. So, like we talked about some of their failed investments earlier, this is probably where it's going to hit them, as they're 0.8 higher than Nike and 0.28 less efficient than Adidas. And in terms of growth rate, Lulu only has a 6.1% growth rate at our current model, while Nike is at 6.6 and Adidas is at 8.95. And Adidas is mildly inflated just because they're doing bad right now. So they're expected to grow a lot more. And then the next area that hammers Lulu is their tax rate. So according to their guidance, they're expecting a 30% tax rate, which is significantly higher than Nike's at 17% and even Adidas at 25%. So this is really hurting Lulu's NOPAT margin. You can see their NOPAT margin drops a whole like 7%, and that's because of the taxes. And in terms of ROIC, this is one of their strong areas. So they're at 26.54, which is 6.86 higher than Nike and 2.54 higher than Adidas. So they are getting some good returns when they do invest capital sometimes, but sometimes their productivity is still overall lower. Now going into their WACC, they're in the middle of the pack here. They're at 10.8, which is 1.3 higher than Nike, but 1.2 lower than Adidas. So they're kind of a middle of the pack in risk in this industry compared to competitors. And so if we go to the overall EV over EBITDA or EBIT, so we can see they're lacking behind Nike and Adidas. So summarizing, they have a superior margin and they do have a better ROIC, but the fact that their growth rate is lower, their tax rate is higher, and their WACC is kind of middle of the pack, as well as their productivity being higher, kind of makes them trade at a discount. All right, can we get the next slide? Okay, going to the next slide, focus on the EV over sales. So we can clearly see EV over sales. Lulu has the highest EV over sales of the three firms, and the main reason for this is because of their great margins. So they have these great margins because maybe they're very, very strong, competitive position. They have a very good brand loyalty. People are usually pretty loyal to Lululemon, as well as their great pricing and profitability. A lot of these other brands like Nike and Adidas have had to lower their prices, and that has obviously hurt their margin, while Lulu has been able to maintain that premium status.
All right, so taking a look at our models here and how we got to our hold evaluation. This is a snippet of our as-is model. This is all taken from the Bloomberg data that we were given. Current share price is $241.95. On the next slide here, we do have our key assumptions in this model. First one is tax rate. Like Ryan mentioned, right off the guidance, this was 30% in perpetuity. Them being a premium company kind of makes sense on this rate as well. Our perpetual EBIT margin, we did set kind of middle pack between the projected margin off of the second and third forward year multiples. So we set that at 22.3. And then the 2030 growth rate was set at 10%, which is the same as 2029, is in line with the strategy, growing here double digits in the next upcoming years. So with these assumptions, the implied perpetual growth here is about 4.4% at that $241.95 stock price. So looking at a bull scenario on the next slide, we make changes mainly to the growth rate, the expected growth rate, as well as the perpetuity EBIT margin. Those being 7.5% and about 1% higher there, or I'm sorry, 0.5% higher at 23% on that EBIT margin. On the growth side, this is really driven by their, assuming a fruitful expansion internationally, mainly in China and Europe, which is where their current focus is on. Like Sarah mentioned, they're also making a big push in membership and online sales, so that could contribute to their growth if successful. Both of those initiatives also can contribute to margin in this scenario here, with both membership and online sales having a lower fixed cost and potentially pushing those margins up to the upper end of that range that we saw in the multiples. So with those two factors there, we do see quite a bit of upside with Lululemon, about 70% at a bull price of $417. On a bear scenario, kind of the inverse situation here. Main changes were on the growth rate that we set at 3%. We also changed the WACC by about 1%, setting that at 11.8% as opposed to the 10% on the as-is model. And our margin put on the lower end at 20%, still pretty healthy, but lower than the as-is model. On the growth rate in this scenario, it's really driven by potential of a U.S.-China tensions continuing to rise. That's their main market that they're expanding in. So for whatever reason that doesn't pay off, it could hurt their growth margins in perpetuity. It can also be affected, just like any other fashion brand, for whatever reason they have an issue being relevant. We saw an example here of a recent line, Breezewood, that had some issues with consumers and didn't sell as expected. So if that continues to happen, it could hurt their growth. And then as far as their perpetuity margin, same deal. With the growth, they can be spending more money on marketing and hitting that margin. And since they're taking more debt, like Rick said, this could impact their WACC as it becomes more and more expensive to borrow money. So in that scenario, we do see some downside with Lulu, about 30%, and setting that bear price at 170 compared to the 241 we see today. As far as Target, we think the upside outweighs the downsides here. We think their strategy is sound. With growing, especially internationally, there's a lot of potential there. The 4.4 growth is pretty reasonable. We set a growth of 5% though, as you see a little bit more upside, especially through the international expansion. We did go with the higher end of the margin there at 23%, driven mainly by the online sales and membership focus that Lulu is having. And there were really no other changes here. We think they have a lot of potential in growth, but not so much as Nike or Adidas, which is more mass market. So we thought 5% was more reasonable than trying to go on a 7.5 and beating Nike, which didn't make sense on an industry that grows about 1% a year. So with that, in conclusion, that's how we got to our hold recommendation here with a 9.5% potential. So just a hair off of a buy. Like we said, it really depends on their growth. That's the main point here of them succeeding. So thanks everybody for your time. We'll be happy to take any questions.
All right, that was right at time. Thank you, Lulu. Investment Committee, Team 4.
Yeah,
Yeah, I can.
oh, go ahead, Spence, if you're ready.
Yeah, I'm ready. So can we talk about your target real quickly? So the first real question I have is if you could explain a little bit about that really high tax rate. So I saw a 30% tax rate, which is kind of insane right now, considering the corporate tax rate is 21. And then the second part of the question is you're projecting a 9% growth, which seems very low. Did you compare that with other people in the industries? Like, do you believe that 9% is like even that 5% is, yeah. So, well, yeah.
Yeah, you go to our our target slide. Yeah.
So, I mean, as far as the tax rate, that was right up the company guidance. Yes, it's high, but Lulu is also a premium product, right? So they making quite a bit of cash on their sales, like we went over. So we don't think it's too bad. As
Yeah.
far as
Sure.
on the side, I think I mentioned at the end there, this is an industry, at least on the manufacturing side, where you can find data. It grows at about 1% a year on the leisure manufacturing. So 5% is already at quite a premium over the industry. Looking at, the competitors that we looked at, Adidas and Nike, which are a lot more geared towards mass market. Nike's growing at 6%. I think Adidas, what was that, Ryan? Like 8.5%. As far
Yeah.
so we thought, especially with a premium brand that is a lot more niche, we didn't want to be too aggressive and try to outgrow Nike. So
Yeah.
that's 5%.
Yeah, sorry. Just talking about the tax rate again as well. I know the corporate tax rate is low, but if you look at Lulu's past effective tax rate, they've been I think that last year last year in 2023 it was like 29.5 and 28. So even though the corporate tax rate is that, their effective tax rate is a decent amount higher. And again, that's because those extremely high margins, they're making a lot of that right into profit, into net income. Versus like if you go back to the PE multiple slide real quick. Yeah, so you can see despite Lulu's size, their net income is pretty it's pretty sizable. I mean, their market cap, they're significantly smaller than Adidas and Nike and Adidas, and they still have a pretty high net income. So that's also gonna affect the reason why they're paying such a high effective tax rate.
Thanks, guys. Yeah, and well done on the presentation. The one question I had, I think it was Sarah, and apologies if I'm getting that wrong. You were walking through some of the EIC stuff. I think for the 5-year projection, we were a little curious as to why the threat for new entrants was low. I think you mentioned like machine learning and social media presence, which makes sense for large companies. But do you all feel that that also could potentially lower barriers to entry rather than raise them? I'm thinking like viral trends on TikTok or like mass sales through like cheap outlets like Temu and other places, potentially letting another brand go viral.
So sorry, the question was if the threat of new entrants in 5 years, if it should be low just because machine learning.
Yeah, I'm
isn't-
asking, should it be something other than low, because brands may have the chance to go viral on social media or get mass appeal through like cheaper outlets like a Temu, which maybe actually increases the threats rather than letting social media and machine learning decrease the threats like you mentioned in the presentation.
Yeah, I mean, I guess I was gonna say, I guess there could be other alternatives. I mean, part of it was because of the machine learning and like more kind of getting involved with like the technology, but I know Lululemon has been doing a lot of expansion like globally, especially with opening up some of their other stores and everything. And I just feel like, at least in this industry, like, yeah, I mean, technology I think can play a role and like online is a factor, but they also are getting more of a global presence, especially in China. So I at least feel like there's a couple different factors that are involved, at least with the threat of new entrants. But I mean, I guess there could be alternatives, or it could be easier for like machine learning and everything. But I feel like there's a lot of AI that I think are being more heavily invested in with the company in order to improve their technology and like online presence too. So I feel like it's a mix of that. And also like, I do think that the expansion of them going into China and like kind of having more of like a local like in-store presence too is probably just going to be harder for others to compete unless they have a lot of capital.
Kind of going off what Sarah says too. I mean, with AI and machine learning being such a new kind of topic, it isn't cheap, and we kind of, through reading through articles and things along those lines, it's tougher for those kind of startup companies to kind of use those certain technologies to grow and expand their companies. Where Lululemon has shown to be able to invest in things in the past, and that have ended up working out for them. So we see that investment that they're going to make is obviously going to decrease, obviously, or increase their growth, but it's more difficult for new entrants to kind of make a name for themselves in the industry.
All right.
Yeah.
This is to the end of our 5 minutes. Sorry to end the conversation because I actually do appreciate the questions that are going on. As a matter of fact, in both the first two teams, I think the investment committee kind of, ask questions of the right areas about the areas of the model that present risk. So good job with those questions. All right, let's move on to Coca-Cola, our next team.
Okay, I can take over the screen share here, hopefully. Let's see. You all should be seeing my screen. I'm a
Yep.
Teams user at work, so apologies but you should see. Cool, lovely, thumbs up.
And if you're ready, I'm going to go ahead and start the clock.
I think we're ready. So we are Team Coca-Cola. I'm Alex Giuliano, for those who have met. The rest of the group will be presenting here shortly. For the sake of time, here's a quick agenda. It's going to look very similar to all of the agendas you all probably are running through this, so I'm not going to drain it. Want to start with our group's recommendation for Coke, which was a recommendation of hold. Right now, as of 8/24 or August 2024, excuse me, Coke is trading at 68.46. Our target price from the model, which we'll get into throughout this presentation, was $64.50. So we're a hold as a group. And to kick off some of our analysis, passing it over to Ryan to start working through our EIC.
So just start off from the Bloomberg screenshots that we were provided. The industry average for what's called the non-alcoholic beverage industry, their industry average beta is 0.60, and Coca-Cola's is slightly lower at 0.58, which means that their industry exhibits lower volatility compared to the market. Coca-Cola is slightly less than that. And that just indicates that Coke is a relatively stable and safe investment, even in a volatile market. Next slide, please. We'll get into the 5 forces of the industry. To start off, we did the threat of new entrants. We had that as low. Coke benefits greatly from economies of scale. They're a huge company. And there's some pretty high barriers of entry to get in just because of the massive players that are already in here. Low to moderate for bargaining power suppliers. Coca-Cola has a bunch of diverse suppliers, so they're not dependent on any one person to get their materials. And their scale minimizes any raw material market price fluctuations, like sugar, which is constantly changing, and their large scale lets them lock in long-term contracts with these suppliers, so the suppliers can't really change much. For bargaining power of the buyers, we have that as low as well. Just due to the mass customer volume that's going to Coca-Cola, their diverse product line, they have all sorts of things, not just your regular Coca-Cola, and they have very high brand loyalty, which kind of protects the very low cost of switching. I mean, I don't know about you guys, but if you like Diet Coke, you're not really trying to drink Diet Pepsi. It just doesn't really hit the same. So even though it's pretty much the exact same price, you're not really going to switch over. Next slide. So then we get into threat of substitutes, which we had as high. There's a very high availability of cola flavored products, which is their main product. There's RC Cola, Pepsi, Dr. Pepper, just to name a few. And there's also a high availability of just regular soda and caffeine substitutes. You could switch to coffee, you could switch to Sprite, like you could switch to a million other things. And health trends are starting to come forward, pushing consumers away from soda and towards healthier drinks. So we definitely thought that was high. And then competitive rivalry, we had as high as well. There's a few competitors on the same scale that we'll get into later, such as Pepsi and Dr. Pepper. The market saturation, extremely high. There's tons of either very small, like soda companies, or very large soda companies. And then a ton of money is in advertising, which just fuels this competitive rivalry. I mean, you have Coca-Cola and Pepsi competing for Super Bowl ads, digital marketing, all of that good stuff. So it's just going to keep getting higher. Next slide, please. We'll talk about the 5-year outlook a little bit. Threat of new entrants, we had it's already low, but it's going to decrease even more.
Coca-Cola and the other major players, they're going to continue to grow. They're going to get bigger. It's going to make these barriers of entry even higher to get into this industry as the years go on. These big players in the industry, they're going to start buying up little companies, which they're already doing. So you're really just not going to have a chance to get in. Bargaining power suppliers, we don't really see anything changing there. The scale is still going to allow them to lock in these long-term contracts, do all this negotiation, not really much change. Bargaining power of buyers, we have that increasing with these healthier options coming out. Consumers might ditch that brand loyalty tact and be more willing to switch, so they feel the pressure to be a little bit healthier, a little bit more organic, which leads into threat of substitutes also increasing. These health-focused soda companies are coming out. To name a few, Olipop, Poppy. I'm sure you guys have heard of them. They're very good. They're very healthy, or not very healthy, healthier than your sugar-filled sodas, which leads into the health trends leaning away from these sugary drinks and towards 0 calories, 0 sugar, fully organic drinks. And competitive rivalry, we also had no change just because those big guys, Pepsi, Dr. Pepper, they're not going anywhere. You're still going to put out these crazy ads, still going to spend a lot of money on advertising, and digital marketing is just going to get more and more relevant as technology increases. And so now I'll pass it over to Gene to finish out the EIC.
Thank you, Ryan. So I'm gonna talk about the competitive advantage today and the competitive advantage in the next 5 years. Coca-Cola has no competitive advantage over rival companies at their ROIC of 11.53% is not above the industry average of 13.5%. Coca-Cola has to be above average and outperforming the competition to have the competitive advantage in the industry. The Bloomberg screenshot show us that some companies have a solid competitive advantage, such as the Vita Coco Company and the National Beverage Corporation, with ROICs of 25.4% and 32.63% respectively. Next slide, please. It could be argued that Coca-Cola is the largest beverage company in the world with a market cap close to 300 billion and a large portfolio of over 200 brands sold globally. Although they do not have a competitive advantage in the industry, we believe they will remain relevant and profitable in the next 5 years. Coca-Cola Company has done an outstanding job adapting to a rapidly changing world and meeting the demands for many generations of consumers. For example, one of Coca-Cola's latest releases was Coke Plus Coffee, a product launched to benefit from the growing demand for coffee products in the United States. Similarly, Coca-Cola has diversified its product portfolio to other non-core brands to capture a broader range of customers. The strategy helps the Coca-Cola Company mitigating risk as soda's global popularity has declined in the last 10 years as consumers become more self-conscious of their health. And finally, the Coca-Cola Company has a large amount of cash on hand, reaching $17.3 billion as of June of 2024. The Coca-Cola Company has a lot of cash, which can be used to increase advertisement, R&D, or simply enhance its distribution network. Having such amounts of cash available to spend and a valuable brand name indicates they can confront chaotic markets and continue to grow and create value for shareholders. And now I will take it over to Matt to go over the historical analysis.
Thanks, Gene. When looking at the ROIC tree for Coca-Cola, the results look mixed category by category, but overall we believe that Coca-Cola is showing stable trends. ROIC, both pre-tax and after-tax, are positive. This is simply indicated by the fact that operating income is increasing at a rate slightly higher than invested capital. The tax rate in 2023 is slightly more than where it was 5 years ago. There was a noticeable increase in the middle, but the trend in the past 3 years have been very good for them, and we'll touch a little bit more on what we expect that rate to do moving forward later on. Operating margin actually decreased by 8.7%. This negative trend was caused by both gross margin decreasing and SG&A slightly increasing. As you can see, depreciation decreased pretty significantly, which is a positive trend. However, gross margin and SG&A are both so much larger that the trend is still negative. Gross margin being down seemingly mostly comes from cost of goods sold. Invested capital on the other side, though, is down noticeably as well. Operating working capital and PPE per sale both improved greatly. Intangible per sales increased slightly, but the other two categories improvements is what led to that near 11% improvement in invested capital efficiency. Next slide. Just to touch on without goodwill, most of the categories are the same, but you can see that our OIC number is very different in this one. Essentially with a company this big, there's a lot of intangibles at play. You think about all the branding. They've done quite a bit of acquisitions over the past couple of years. Essentially, that's a big thing to consider with a company of this size, and that's where those differences come from. And obviously, invested capital per sale down 40% when you consider that instead. Definitely something worth considering. And in the end, invested capital per sale is the most notable ROIC driver, showing operational efficiencies increasing to a pretty drastic degree. Next slide. Now going on to the CFI analysis, we can start with gross cash flow. Gross cash flow has seen pretty consistent growth over the past 5 years with a slight dip in 2020. Free cash flow is a bit of an interesting story. Capital expenditure was really high in 2019, as expressed by that CapEx over depreciation ratio that we see there at 291%. After that, it dropped and has kind of gone through biannual waves, a little bit higher one year, very low the next. Interestingly, investment on goodwill and intangibles is a bit all over the place as well. Big investments in 2019 and 2021 kept the free cash flow down quite a bit, but in the last few years, we have seen it actually go negative. But when we look at the actual CFI itself, you can see that it has stayed pretty steady over the past 5 years outside of a spike in 2021 caused by a rare year of non-operating loss and decrease in excess cash. Excess cash is down $5 billion in the past 5 years, but that is nearly all caused by that 2019 number. And as Gene mentioned, they still have plenty of cash to throw around. Non-operating gains and after-tax interest income are the other big drivers there. But when you look at how it was paid out, over 81% went as common dividends. So the rest is split in a variety of ways. After-tax interest expense was a notable category as well. But yeah, it's split pretty evenly. So now I will give it back over to Alex to go over the multiples.
Yeah, thanks, Matt. Just want to briefly touch on the comparable companies. I don't think either of these are shockers based on what we've been talking about so far, but we compared Coke against PepsiCo, which is the combination of actually Pepsi and Frito-Lay, as well as Keurig Dr. Pepper, which is the combination of Keurig Coffees, Dr. Pepper, and then a bunch of other brands. Both felt like reasonable comparisons based on their size and stance in the industry. Starting with the PE multiple comparison, the top line item here is that Coke trades at a premium to both PepsiCo and Keurig Dr. Pepper. Starting with PepsiCo here on the left-hand side of the slide, we see that PepsiCo's spread is actually slightly higher than Coke's at 43.73% compared to Coke's 38.96%. And PepsiCo has a lower cost of equity than Coke at 7% versus 7.4%. However, the main driver at Coke trading at a premium here based on this multiple is Coke's growth rate of 3.56% compared to PepsiCo's 2.50%. So Coke's healthy spread compared with a high growth rate compared to Pepsi leads to it trading at a premium. And then looking at the Keurig Dr. Pepper side on the right hand here, we see Coke has a significantly higher spread of 38.96% compared to Keurig Dr. Pepper's 3.38%. And although Keurig Dr. Pepper does have a slightly lower cost of equity of 7.3% versus Coke's 7.4%, and a slightly higher growth rate of 3.75% compared to Coke's 3.56%, Coke's massive advantage across the spread paired with its still healthy growth of 3.56% results in it trading at a premium. We have some of the big numbers listed at the table at the bottom there. Highlighted in red are the PE multiples. We see Coke at 24.02, which is higher than both PepsiCo at 21.13 and 18.27, resulting in that premium rating. with that, I'll pass it to Mike to talk through some of the EV multiples.
Thank you, Alex. All right, so here we can see that Coke trades at a premium to Pepsi and Dr. Pepper, with the EV/EBIT multiple of 23.13 versus Pepsi's at 18.71. The premium can be attributed to a bunch of different factors, as you can see here, like the spread, cost of capital, growth, and tax rate. So when comparing to Pepsi, Pepsi actually has a better spread and lower cost of capital, but Coke benefits from a little bit of a higher growth rate and smaller tax rate. And then over on the right, comparing it to Dr. Pepper, a lot of the same comparables. The main thing that sticks out, though, is that Coke's spread is significantly higher, standing at 30.06%, compared to Dr. Pepper's at 1.33%. Overall, Coke's higher EV/EBIT multiples compared to both Pepsi and Dr. Pepper are driven by their strong growth rate, lower tax rate, and especially its significantly higher spread. As we can see, Pepsi enjoys that lower weighted average cost of capital and higher spread, but Coke's growth and tax advantages give it that premium valuation. But yeah, Coke has the best margins out of the group, showing that they have the highest EV to EBIT and EV to sales. And these metrics clearly show that Coke's strong financial performance and market position, which clearly justifies its premium trading multiples relative to its peers. Then let's switch it over to Spencer.
Yep.
I'll hop in before Spencer on this one. So starting with our valuation models, across all four models, we had a handful of constants. The constants were provided from the Bloomberg screenshots. We had a 6.9% WACC, 4.3 billion shares outstanding with a current share price of $68.46. Also down below, provided from the Bloomberg screenshots, the EEO screenshot specifically, we have the consensus revenue and EBITDA numbers, as well as the EBITDA margin, which we can see is projected to grow year over year, but maintains an average over the 5 years of about 34%, as well as an average 2-year estimated EBIT margin of about 31%. And then going on to our as-is model, those constants all stay the same, and we utilize 4 main levers to arrive at a model share price of $68.46, matching the current share price. The first lever we pulled was the revenue growth rate, which we set at about 5%, which is equal to the 2028. As you see, between 2024 and 2028, it's supposed to continue growing. We definitely foresee Coca-Cola continuing to grow, move into some of these new markets, as well as continuing to acquire some of these new up-and-coming companies, which will help grow their revenue overall. Turning next to the EBITDA margin, we set about 33.5%, a smidge below their current average consensus estimates. In the past couple of years, they've been running about 30% actuals, and we deem that this gives a little bit of upside, but maintains realisticness and is attainable in the long term. Also, in the as-is model, we set a tax rate of about 19% based on the company's guidance provided via Bloomberg, and we solved for a perpetuity growth rate of about 3.24%. The combination of these assumptions gave us a $68.46 share price, matching the current price. Going on to our next slide, we put on our rose-colored glasses and went for a bull model. Overall, we arrived at a share price of $117.35, which is about a 69% upside over their current. It's pretty amazing that we were able to boost the stock price so drastically with keeping some of the assumptions so close to our as-is model. For example, the revenue growth rate here, we moved it to about 5.5%. For such a large company, growing 5+% year over year is already fairly difficult. And we deem that this was already fairly rosy with a bit of upside on that as well. EBITDA margins fairly in line with their consensus estimates over the years. We see upside in keeping supply prices low, but also they do have to balance out sale prices to customers to keep their customer base. And therefore, we decided 34% margin was fairly rosy, yet realistic. The tax rate was set at 17%, assuming a Republican switch of not only the White House, but also the Congress, where they'll be able to push through these corporate tax cuts that they've been talking about for a couple of years. And the final lever that helped us get to that $117 share price was our perpetuity G, which we set at 5% for this one. Assumes that they're going to continue expanding into these trending markets, as well as acquire some of these new companies that will help get into these markets. And then I'll turn it over to Spencer, who will walk us through the bear and the target models.
Yep. Real quickly for the bear, taking the opposite position on the White House shift. So it shifts Democratic and they bring the tax rate back up to 28%. Coke has been operating below the corporate tax rate, so we shifted their tax rate up to 25%. Along with that, the industry is very hard and the supply chain can be very difficult, especially in established business. So there may not be too much margin they can play with. So if their margin starts to slip, their supply chain starts tightening due to weather or climate change conditions, you could see that margin start to slip down. So that's the first lever we pulled down to the bear model. The next are the revenue growth rate and the CV growth. Both we brought down. Coke is an established company, and if they're not able to make the switch to healthier drinks, then they may see a severe decrease in their growth rate, causing us to have a share price of 41%, about $20 less per share than what is currently at.
We're at 20 minutes. We give you about 30 seconds to kind of go through the target.
Just real quickly, Coke is an established company. Let's go through the target real quick. So Coke is an established company. So we're saying their EBITDA margin would come down just slightly. We kept their tax rate the same. So their tax rate really wasn't going to shift much for that. Their growth rate would come down to 3.5. So just steady growth just above the annual inflation target. So yeah, anyway.
All right. And your final recommendation again was
is a hold at $64 a share.
Okay, great. Thank you. All right. So team 5, you are the investment committee questions.
Yes. Hi. First off, great presentation. But my one question is, to combat the substitute threats, do you guys think there's an opportunity for Coke to jump into the health drink game like you talked about with the Olipop and the Poppy, if not already? So that's kind of more my question. Do you feel like there would be an acquisition there? Kind of what?
Yeah, I can take that. So I think there's definitely opportunity for them to just eliminate that threat by buying up some of these health drink companies. And honestly, I wouldn't be surprised if they did in the somewhat near future, just because there's so many of them popping up and they all kind of really do the same thing. Wouldn't be surprised if Coke just tries to acquire like the biggest or second biggest one and just get their foot in that game.
I have a follow-up to that response. So if you guys are expecting an acquisition with the cash that you mentioned is on hand, how did that factor into your models in your, I'm assuming that would be in your bull model?
So yeah, I mean, there is talk about like acquisition, but we didn't really price in the acquisition. That would be from inorganic growth. So when you see the growth rate of 5% and like in their revenue growth and your CV growth, that is really where you price in that acquisition, because it wouldn't be from organic Coke sales, right? You'd see the decline in Coke as well as the increase over that new, like let's say they bought Olipop, for instance, you'd see the increase in Olipop, but you'd also lose in the decline. So if you saw an 8% increase, you may also lose a little bit. So that's where we kind of priced in that acquisition ability.
I think Spencer nailed it pretty well. It's a little bit maybe outside the horizon that we're currently looking at. It's 4 to 5-ish years. With the company the size of Coca-Cola, it's going to take a little while. It'll get probably likely held up in the courts to some degree. And we just didn't really deem that it was, on top of the inorganic growth nature of it, we just didn't deem that it was a likelihood valid enough to put it into the model at this point in time.
I have another question. So in your bear model, I think, Spencer, you mentioned that you shifted the tax rate up to 28%. However, I noticed that the tax rate on the bull model says 25% for 24 through 29. I'm just curious where the 28% factored in there.
So yeah, so we took a approach with, if you go back to our as is, so you can kind of see the what we do
Hey,
right currently.
Ben, sorry to cut you off. I think you just flipped EBITDA margin and tax rate when you were talking on your talk track. I think the 25% tax rate.
No, sorry. 25% is the correct tax rate. So
Yeah.
what I'm saying is the tax rate is actually down. So if you go back to the as is, you can see that is also trading below the corporate tax rate right now too. Coke is doing some funny business with their taxes, and we're predicting that they're able to keep that up and win their appeals. So a little fun stuff. So
But I think
that kind of is
good, Spence. Sorry.
Yeah. So Coke is able to shelter a lot of their losses and get their tax rate below the actual corporate tax rate because they're bringing it in through other places. So if they bring it up to a 28% tax rate, they'd still be trading below that, if that makes sense.
Thank you.
Good deal. One more question or another question for you guys. I think it was in Bloomberg, they talked about Coke had recently partnered with Topo Chico, or maybe it was Coors, and the two of them make Topo Chico hard seltzers. Do you see Coke kind of going further into the alcohol space, or do you think that's something that is kind of, would be against their brand? If they do go into the space, do you think it represents future growth that isn't necessarily priced into the stock?
Ryan, I can start if you want to take the second half too, but I can at least say, Thomas, that's a great question. I think from some of it, Coke already has like the Coke plus Jack Daniels, at least as part of like, I'm not intimately familiar with the type of setup they have, but I assume it's some form of licensing work between the two. So they're already dipping their toes into the alcohol business, as are at least Keurig Dr. Pepper in terms of mixers and a couple other things. So I do think from a competitor and maybe industry trend, they may be skewing that way. I think potentially from the pricing it in perspective, some of the health trends still aren't going away regardless. And as much as it may begrudge some of us, alcohol is not a healthy beverage. So I think while there's room for expansion, it's still obviously something that sells well. I do think some of the gains that could be made there could be undercut from the health industry. So it probably factors into our bull model more so than our target. But Ryan, I don't know if you have extra thoughts, or Ezra and Spencer from a model perspective.
Yeah, I mean, you pretty much covered everything I was going to say, but they do. Yeah, so it was Coca-Cola. They outright bought Topo Chico like 6 or 7 years ago, I think. So they're definitely in that space. And Alex mentioned the Jack and Coke. It's specifically Jack and Coke in a pre-mixed cocktail can. And I think they also own the Simply Spiked lemonades too, as well, if you've ever seen those in a store. So I don't think it's against their brand by any means, especially when something like Jack and Coke or Whiskey Coke is such a big name of a drink that a lot of people get. So I don't think it's against their brand, and I wouldn't be surprised if they dip their toes in it a little more, but they have a pretty good thing going right now. So I don't think it really would change any of the models.
Cool. I think that makes a lot of sense. Thanks, guys.
Good job, teams. Good job with the questions as well. Good dialogue. So what I want to do is, we have a long night ahead. Let's go ahead and take a quick 5-minute break. And we will start back at 7:55 with Dick's Sporting Goods. So the Dick's teams be ready, and we'll just pause for 5 minutes. So is the Dick's team ready? See, it's on the screen.
We are.
All right, I'm going to go ahead and start the timer.
All right. Hello, everyone. So we decided to do Dick's Sporting Goods. We are recommending buy with a target price of $242. Our group is made up of Eleanor, Ayuk, Noah, and myself. Next slide. Next slide. All right. So Dick's is not a very economically sensitive company when compared to the industry and the overall market. With a beta of 0.75, Dick's is 0.25 less sensitive than the overall market and 0.24 less sensitive than their industry. Next slide. When we take a narrow view of Dick's industry and focus mainly on sporting retail, We see that the industry is attractive and that DIX has a competitive advantage with a spread of 6.25% compared to an industry spread of 3.4%. As we get into the five forces, this narrow view of the industry is relevant in helping to understand why threat of new entrants is low. Next slide. But when we look at retail more broadly, we see that DIX does not have a competitive advantage. The broader industry is attractive and shows a higher spread compared to DIX at 7.82%. We think this view is useful in helping to explain why DIX struggles in areas of buyer power and rivalry among competitors. Next slide. So getting into the five forces, we'll start with threat of new entrants. This is low and will remain low for the next 5 years. DIC's 857 brick and mortar store locations represent high capital requirement. Additionally, with the bankruptcy of Sports Authority, DIC's was able to improve their incumbency advantage. Sports Authority had over 450 stores and DIC's was able to move into their most appealing locations. Another reason we see threat of new entrants remaining low is that as brands increase in popularity, DIC's is able to bring them into their own stores. An example of this can be seen with footwear brands On and Hoka. Their integration drove footwear revenue from 19% in 2019 to 26% of revenue today. Moving on to power of suppliers, we see this as very low and remaining very low over the next 5 years. In 2017, DIC's dropped 20% of their suppliers, and they started to focus on private label brands. These in-house brands now represent 13% of revenue and have 8% higher margins. Furthermore, they have shown a willingness to walk away from low-margin business segments, as they recently did in the hunting and fishing space. DIC's is able to walk away from low-margin segments because they sell products for 32 different sports. By creating options through the private label brand and showing a willingness to walk away, DIC's has managed to keep supplier power very low. An area where we see that DIC's struggles is buyer power, which we see as high and remaining high over the next 5 years. The reason for this is because switching costs for consumers are basically non-existent. A customer can go to DIC's, try on a pair of shoes, and then immediately order them from Amazon. This dynamic forces DIC's to offer additional value to customers. This is playing out as an increase in CapEx, up from $198 million in 2019 to $800 million in 2024, as they implement their House of Sports model, which offers a more experience-based shopping. When it comes to threat of substitutes, we view substitutes for DIC's Sporting Goods as really any way that people decide to spend their free time. As people age, they become less active. According to a Harvard study, roughly 75% of children play a sport, but less than 25% of adults report playing a sport. Next slide. This graph shows how the U.S. population is aging, with younger demographic shrinking and the older demographic increasing. Because people become less active as they age, this is not favorable for DIC's. Because of this, we believe that the threat of substitutes is high now and will be higher in 5 years. Next slide. When it comes to rivalry among competitors, we see this as high. While there may not be a lot of direct competitors like Academy Sports, many retailers have overlapping products with DIC's. Next slide. This chart shows where people report buying sporting goods over the past 24 months. As you can see, it's all over the place. This chart hammers home the point that within the broader retail, DIC's does not have a competitive advantage. It's notable that Amazon tops the list of the most frequented places to buy sporting products, with 40% of consumers purchasing from there compared to only 30% at DIC's. We believe that 5 years from now, the rivalry among competitors will be higher as Amazon will strengthen their competitive advantage in operations. Next slide. Overall, we believe that over the next 5 years, DIC's will improve their competitive advantage in the sporting-focused retail space as their strategy to reduce supplier power plays out and their House of Sport concept is implemented. However, these efforts will not be enough to earn them a competitive advantage in the broader, highly competitive retail industry. Next, I'll pass it off to Ayoka.
Now we're going to look at the historical analysis. So RIC increased by about 247%, rising from 6% in 2020 to 19% in 2024. The main drivers were tax rates improvements of 23.8%, decreasing from 27% in 2020 to about 21% in 2024. The next was also a pre-tax RIC increase by 219%, going from about 8% in 2020 to 24% in 2024. And these improvements came about because productivity improved by about 28%, due to investment capital to sales dropping from 56 cents per dollar in 2020 to 40 cents per dollar in 2024. Also, operating margins improved by 130%, increasing from 4.3% in 2020 to about 10% in 2024. Next slide, please. So the growth in operating margins was due to an increase in gross margin by 18%, going from 32% in 2020 to 38% in 2024, with a spike in 2022 to 41%, where they had, I think they're breaking records in net sales of about 12.4 billion because of changes in their operation strategies. SG&A and depreciation had little effect on the operating margin, as SG&A only increased by about 0.6%, a percentage point from 2020 to 2024, while depreciation expense decreased by just 1.8%, staying around 3% in all 5 years. Improvements in productivity was due to 30% improvements in PPE to sales, which went from 42 cents per dollar in 2020 to 30 cents per dollar in 2024, indicating that that more revenue was generated from existing stores. Additionally, intangible to sales improved by 40%, dropping from 3.9 cents per dollar in 2020 to 2.3 cents per dollar in 2024, showing efficiency in using their intangible assets to generate sales. There was a decrease in working capital by 14.9%, which might have hurt Dix a little bit. They went from 9.9 cents per dollar in 2020 to 8.4 cents per dollar in 2024. I think the shrinkage in working capital is some kind of an indication that they are spending a lot of cash on long-term assets and also have increased balances in accounts payable. Next slide, please. Now we'll take a look at the five-year CFI summary. Free cash flow Dix generated a total of $6.2 billion in gross cash flow, which gradually increased with each year, of which they reinvested $4.4 billion, with 91% of these investments in capex, giving them an average reinvestment rate of about 72%. After reinvestment, free cash flow left was about 1.76 billion. They generated extraordinary gains in the amount of 78 million, indicating possibility that some of their assets were purchased below market value, which was to their advantage, leading to a total operating cash flow of about $1.83 billion. In terms of the cash flow available to investors, Dix had a non-operating gain of 150 million. Their excess cash totaled about 1.6 billion, with most of it coming in 2021. Their non-operating assets totaled about 657 million, leaving them with a total of minus $269 million in CFI. The negative CFI indicates that they spend more and receive less from investment activities. Also, this could also be it's not a sign of poor health, but a reflection that they are reinvesting into the business for future growth. Next slide, please. So in terms of the flow of debt and equity, Dix paid out about 211 million in interest. They borrowed $4.2 billion worth of debt and paid out about $1.3 billion in dividends. And we purchased $2.7 billion worth of stock, indicating overall confidence in their financial health. In total, Dix paid out about $3.9 billion to shareholders, which explains the $4.2 billion in debt, given that cash flow available to investors was in the negative. Next slide.
Okay, so for the multiples, first off, we decided to compare Dix to Foot Locker and to Academy due to Dix plan to increase in footwear, and Academy is a direct competitor. So first we started out with the price to earnings analysis. So Dix is currently trading at a premium compared to Academy and Foot Locker, showing its dominance in the industry with a PE ratio of 14.59. Foot Locker is quite similar at 14.57, while Academy's is much lower at 7.15. So the first thing that we wanted to point out through this was the growth rate. So Dick's is currently growing at 2.35%, whereas Academy is shrinking at a growth rate of negative 12.86%, and Foot Locker is growing the most at 7.26%. So second is the spread between the ROE and the COE, which Dick's has a strong spread of 23%, which is far higher than Academy's at 10.6%, and Foot Locker's at 4.2%. The disparity in the spreads, along with their differences in growth rates, helps explain their PE ratios. Third, we also looked at the cost of equity, reflecting the risk each company faces. So Dick's actually comes out on top with the lowest COE of 8.7%, making it the least risky investment. Academy follows with the 9.9%, and Foot Locker with the riskiest COE of 10.8%. Lastly, it's important to note that the expected ROE for these PE ratios are best based on historical data, except for Foot Locker, where we are adjusting their forecast from a negative ROE to a more realistic 15% to maintain a positive spread. Next slide, please. So the EV to EBIT ratio. So when we calculated the EV to EBIT ratio, a few considerations came into play. One was figuring out the ROIC without the cash flow valuation for Foot Locker and Academy. So using the model from class for Academy, this gave us an ROIC of 14.53. And since Foot Locker's ROE were relatively consistent historically, we actually used their ROIC of 1.43 as a proxy for future performance. With these assumptions, we see that Dick's trades at a premium to Academy, but at a discount to Foot Locker. So these differences might be due to various factors like tax rate, WACC, spreads, and growth rates. So Foot Locker's high tax rate of 35.5% compared to Dick's 23% and Academy's 22% is particularly noteworthy. Although the tax rates don't heavily influence our model, they do have a negative impact on this multiple. So the growth rates are a big deal here too as well. So Foot Locker and Academies have negative growth rates of 1.9 and negative 9.76, while Dick's is growing at a more standard rate of 2.55. Another contributor to Academy's lower EV to EBIT multiple is actually their lower spread, which is 6.13 compared to Dick's 13.8. And Foot Locker actually has a negative spread of negative 5.27. So the negative growth and negative spread help explain Foot Locker's EV to EBIT ratio being higher, as this kind of cancels each other out with using this model. So the WACC also tells the risk of these companies, showing Dick's being in the middle of the pack for a risk of 7.8%. Compared to Foot Locker and Academy's 6.7 and 8.4. So also breaking down the analysis on Foot Locker further. So Foot Locker has 3 times more debt as a percentage of its capital structure compared to Dick's, and twice as much as Academy's. So this means that when calculating the EV, the enterprise value goes up more on a percent basis compared to Dick's or Academy. On the EBIT side, Foot Locker benefits from the lowest debt cost at 3.7% compared to 4.2% for Dick's and 4.7% for Academy. Since the interest expense is also a part of EBIT, Foot Locker's lower rate keeps the impact of EBIT smaller, which infiltrates their EV to EBIT ratio. So while this multiple might seem useful, it might be the most unreliable when using in this context. And then finally, the EV to revenue multiple. So like the P/E ratio, Dick's trades at a premium in terms of the EV to revenue multiple, with a multiple of 1.43 compared to Academy's 0.77 and Foot Locker's 0.68. So this premium is driven by several factors. One of those is going to be the operating margin. So Dick's has an operating margin of 11.2, while Foot Locker and Academy are at 3.9 and 10.7 respectively. Productivity also plays a role. Foot Locker has a productivity ratio of 1.75, while Dick's is the lowest at 0.4% productivity level. So growth rates are also critical, with Academy and Foot Locker having negative growth rates and Dick's having a positive growth rate of the 2.55. And then tax rate also plays a role into this factor, as Foot Locker's lower EV to ratio might be due to its high tax rate of 35.5%, as previously discussed.
All right, so now we've gotten to our model section for the as-is, bull, bear, and target models. Here is our as-is model for DICK's. Long-term growth rate is negative 1.87%. This was found using Goal Seeker once the other data had been added and updated on the model. Please notice the perpetuity EBIT margin is not a range and will be exactly 11.3%. The 2030 revenue growth rate is the same as last year at 2.9%. The operating income will need to equal the 11.3%, which we noticed earlier. So the EBITDA will need to equal 14.3%. And in looking at the corporate guidance, tax rate is forecasted to equal 23% in perpetuity. When using our goal seek on the long-term growth rate, we arrived at our $215.25 share price. Here is our bull model for DICK's. We bumped up the long-term growth rate from negative 1.87% to 1.25%. Same goes for 2030 revenue growth rate from 2.9% to 4%, EBITDA from 14.3% to 15%, which caused operating income to grow to 12%, and we decreased tax rates from 23 to 18%. When all is said and done, this led to a bull share price of $311.40 compared to the OG price of $215.25. The bear model for DICK's is this one. We decreased long-term growth rate from negative 1.87% to negative 2.8%. Similarly, we decreased 2030 revenue growth rate from 2.9% to 2%, EBITDA to 13%, which caused operating income to fall to 10%, and we increased tax rates from 23 to 26%. After all the negative hits, we come to a bear share price of $176.54 versus $215.25 once again. And here's our target model for DICK's. We increased long-term growth rate from negative 1.87% to negative 0.75%. We increased 2030 revenue growth rate from 2.9% to 3.5%. We increased EBITDA margin just slightly from 14.3% to 14.5%, which increased operating income to 11.5%. And lastly, we decreased tax rates from 23 to 21%. We are projecting a bullish target share price of $242.21. This is compared to the as-is share price of $215.25, or an increase of 12.52%. When considering the bullish and bearish factors, we have determined that the bullish factors are both more realistic and more impactful. Given strong operations and the growing footprint of DICK's, we do not think the loss of key brand relationships and business partnerships are very likely. Those were two of our bearish assumptions. In fact, with the increase of brand-owned merchandising and our estimate that it will be increasingly easy for DICK's to establish partnerships with key brands, we have increased 2030 revenue growth rate from 2.9% to 3.5%. Although EBITDA could take a hit from the initial cost of brick and mortar and House of Sport expansions, we expect each of these to be positive factors in perpetuity, and as soon as 2030, strong operations, momentum, customer acquisition, retention, and brand loyalty should all be boosters for continued EBITDA and operating income growth. We believe that the normalization of pandemic level spending has already occurred for the most part. We believe that experience opening operations in new territories will assist in their expansion efforts and limit expansion risk. Because of these factors at large, we have targeted an increase in EBITDA from 14.3% on the as-is model to 14.5%. We have also targeted a related increase in operating margin from 11.3% to 11.5%. We foresee a drop in tax rates from 23 to 21%. We believe that a conservative presidency could happen, which could correlate to a decrease in tax rates. However, we have not dropped rates near the bull rates of 18% because other economic factors could curve an overall decrease. When considering long-term growth rate, we believe that the forces at play will lead to a more positive outlook. I already mentioned most of our reasoning for this. However, in addition, the increase in owned brand merchandising will continue increasing margins while building customer loyalty and lowering costs of customer acquisition. Once again, we do not believe future or current partnerships are at threat. Their expansion efforts will pay dividends metaphorically for years to come. Lastly, their new game changer apps adoption should enhance customer engagement and continue driving sales. We have targeted an increase in long-term growth rate from negative 1.87% to negative 0.75%, and would not be surprised for this to move into the positives if their successes and momentum over the last 5 to 7 years continues forth. Because of our target share price is an increase of over 10% at 12.52%. Once again, we are recommending a buy for DICK's. thank you very much. And any questions?
Thank you, Team Dix. Team 6, you're up.
Yeah, great presentation. Can you guys hear me?
Yes.
Okay. Yeah, I was just curious if you guys looked at the, a lot of these, I'm sure you've seen on the news, like somebody, like a lot of these organized retail crime. And I was just curious, like on your target model, if you consider that at all, and is there any like change of business strategy or model impact your target model? Thanks.
Yeah, so actually we did a decent amount of research on the different trends that could impact long-term growth rate and 2030 revenue growth and EBITDA, and that actually didn't come up in our research. I'm kind of surprised, but we didn't factor that into our models.
No worries. Thank you.
I have a question about the betas. I know, Thomas, you talked about how the beta for Dix was less than industry average, and it was also less than 1, so it's less sensitive to the economy. Do you have a reason for why you think it's both less sensitive to the economy as well as below the industry average?
I think part of it is probably they're best in class as far as sporting retailers go. So when people are deciding where to buy their sports goods from, if they're going to go to a sporting goods store, it's going to be more likely than not Dick's compared to Academy Sports. And the other reason maybe could be that Dick's has a pretty wide base as far as like the different sports that they offer on, as well as clothing and apparel and things like that. So maybe spending drops on golf clubs, but they still have apparel and clothing that people need to, continue to buy and replace. So maybe things like that help them be less economically sensitive overall.
Thank you.
Sure.
Hey guys, nice presentation. I just was curious about the free cash flow. I saw one slide where Dick is like making 6.8 billion and then like reinvesting around 72%, like 4.4 billion. So is it like they are investing for expansion or just improving their current operations? I just felt like 72% of reinvestment, is it sustainable or not, like,
Yeah, from the research I did, they are building a lot of new facilities with their House of Sports initiative that they started. So that's where a lot of that investment is going. I don't know if it's going to be sustainable, but I would imagine that at some point they will slow down once they start meeting the revenue that they require.
Okay. All right. Yeah, I was just curious. Yeah, go ahead.
And just to jump in, it not only the expansion of the House of Sport concept, but there's also a lot of brick and mortar expansion as well. I think Ayuk mentioned that too. I actually went into a new Dick's retailer in downtown Boston like 2 weeks ago, and it was gigantic and super modern, and it seemed like a lot of their in-store strategy is kind of adapting as well. So maybe that's where some of the large reinvestment comes from, all of those factors.
Cool. Yeah, I was just curious. Thanks a lot. Thank you.
And the spending on it is projected to be maxed out this year at 800 million, and it's going to taper off every year going forward for that House of Sports expansion. And it's like a 50-50 mix, I think, between their opening new locations and also refurbishing old locations.
Understood. Thank you very much. Thanks.
Hey guys, nice presentation. I had a question about the online channel. Like, is there anything they're doing there in terms of strategy? I know you mentioned the app at the end. Is that like for shopping or interaction or both, or like what kind of things are they looking at online? Since you mentioned Amazon as a factor to chip on their shares.
Yeah, sure thing. So I can touch on that a little bit. So for the app, it seems like the app is used to increase order size as well as engage within the store. So I think there's a little in-person engagement, maybe a little gamification, as well as trying to leverage that into higher spend per customer and less less cost of customer acquisition as well. And then I know since the new CEO took over in 2017, it's been a little bit, but she had a real focus on digitalizing the organization. And so since then, there's been a huge effort to really move all of their operations digitally so that people can, order more efficiently online and all of that.
All right. Thank you, Dix. Thank you, Team 6. Good job. Next, we have Royal Caribbean.
Let me stop sharing 1 second.
All right, Royal Caribbean, are you ready?
Yes.
All right, you're on the clock.
Okay, so hello everyone. Our team will be discussing the analysis we perform for the Royal Caribbean Cruises. It operates like fleet of modern and innovative cruise ships under multiple brands, including Royal Caribbean International, Celebrity Cruises, and Silver Sea Cruises. It's known for its setting new standards in cruise industry with like onboard amenities, entertainment, and sustainability initiatives. And this is our agenda. Next slide. Our recommendation for today is hold with a price of $168.22. And here are my project team members. With this, I would like to invite Sarah to go over the EIC analysis.
Good evening. I'm going to talk about the EIC analysis. For starters, I'm going to talk about the betas. This is the beta screen that we got from Bloomberg. Right here a little more clearly, we have an industry beta for the cruise line industry of a 1.75, and Royal Caribbean has a beta of 1.48. So both those numbers are above 1, so they're both sensitive to changes in the economy. People are going to buy more cruises when the economy is doing well, and fewer cruises when the economy is not doing well, which makes sense. It's a luxury good. Additionally, our team talked about how cruises tend to have very lenient cancellation policies, which further amplifies their sensitivity to the economy. However, we also see that RCL is able to maintain a beta that's slightly less than the industry average, so it's a little bit more protected by changes to the economy. Some reasons for that are their focus on fuel efficiency, their technology upgrades, as well as a differentiated product to stand out from the other brands. Some of the risks to the industry include economic downturn, volatility in fuel prices, and deterioration of their ships and availability of shipyards as their fleets become aging. Next, we're going to talk about the industry and some of Porter's 5 forces. So we see that the industry WACC is at 8.68. Their ROIC is a 10.48 with a spread of a positive 1.8%. So they are a slightly attractive industry. Some reasons for that, when we look at supplier bargaining power, that's slightly unattractive. There's only about 4 major shipyards that are producing some of the cruise ships that we see. Additionally, substitutes is very moderately unattractive. Right now, cruises are only 2% of the tourist market share. So there's a lot of room for other opportunities like land-based vacations, resorts, etc. Threat of new entrants, however, is very attractive because it's very costly to manufacture a ship over $1 billion for one of the new ships to compete with something like Royal Caribbean. Buyer bargaining power is moderately unattractive. We didn't see many incentives for customers to monohome on a specific line like Royal Caribbean. And rivalry is moderately attractive. It's an oligopoly. You have basically 3 major players: Royal Caribbean, Carnival, and Norwegian Cruise Lines. In the next 5 years, how we see this changing, we don't see much changing in supplier bargaining power or rivalry. Where we do see changes is potentially in buyer bargaining power if they're able to kind of more collect on the brand loyalty and some incentive programs, especially as they build their brand post-pandemic. We look at substitutes right now. This last year, 82% of cruise participants said they would cruise again, and also first-time cruisers are up from 27% to 12%. So they have a lot of market share to capture, going up from the 2% to potentially higher in the tourist industry. Threat of the new entrants should also increase basically the attractiveness of the industry because cruise ship costs will only get more expensive. So overall, we see an increase in the attractiveness of the industry going forward. When we look at Royal Caribbean specifically, so while the industry has a spread of 1.8%, Royal Caribbean has a spread of 5%. So it's much more competitive, has a higher competitive advantage to the industry overall. Some of the reasons for that, so we look at first the WACC. The WACC is 9.91% with an ROIC of a 14.91, which gives us a spread of 5%. The reasons for why it's able to maintain that higher spread and have more competitive advantage: supplier bargaining power. They're big on negotiations, which has helped with their fuel optimization as well as workforce management. For substitutes, they have an advantage in they've been called out basically as the one cruise line to be able to stand head on with land-based activities alternatives, so they can compete directly with your resorts, theme parks, etc. Threat of new entrants, they don't have any major advantage compared to their other competitors. Buyer bargaining power, they perhaps have one of the strongest brand name recognitions for a quality cruise as one of the major cruise lines. So they've used that as well as their differentiation in ports, offset slightly by the fact they don't have as many international ports as the other major cruise lines. And then rivalry, you just only have 3 major competitors, and they're the second largest by market cap, but they've also been the leader in fuel efficiency and technology upgrades. And then finally, in the next 5 years, we don't see much of a change in buyer bargaining power and threat of new entrants. We do see increases in buyer bargaining power, substitutes, and rivalry, specifically with the substitutes that they're able to keep on the edge that they have, as well as the rivalry with the technology and fuel upgrades, and buyer bargaining power if they're able to expand in international markets and capture some of those. And now I'm going to turn it over to Samir, who's going to talk about the ROICT and drivers.
Thanks, Sarah. So ROIC increased 27% over the past 5 years, from 8.9% to 11.3%. It stayed in the negative between 2020 and 2022, declining to negative 19% in 2020 due to COVID. It has since recovered, followed by a 3.3% increase from 2020 to 2021, and a significant 13.5% improvement between 2021 and 2022, and finally turning positive to 11.3% in 2023. Since their tax rates are 0%, as we'll talk about later, this is explained by the favorable pre-tax ROIC, which also increased by the same 27%, from 8.9 to 11.3%, which helps the ROIC. The rise in pre-tax ROIC is explained by the 8.9% increase in the operating margin from 0.190 cents in 2019 to 0.207 in 2023. The operating margin increased despite the gross margin declining about 2.6% from 0.560 in 2019 to 0.545 in 2023, which was offset by the 8% decline in SG&A and 0.256 from 0.256 to 0.234, and the efficiency and depreciation, which decreased 8%. On the other side, the invested capital per sales also decreased 14.3% from 2.141 to 1.834, also helping the ROIC. So the operating working capital per sales went more negative by 0.061, contributing negatively to the invested capital per sales. However, PPE per sales decreased 0.178 cents, indicating a more efficient use of assets and contributing positively to the invested capital per sales. And the intangible per sales also decreased from 0.127 to 0.058, indicating less spending in new acquisitions and helping lower the invested capital per sales as well. Next slide. Looking at the free cash flow over the 5 years, RCL burned about $8.5 billion, generated $2.4 billion from the income statement, and reinvested all of it and more, with the total gross investment of $11.5 billion, with about $13.9 billion going toward capex and $2.5 billion saved in working capital, resulting in an investment rate of 476% over the 5 years. This left them with the negative $9 billion after reinvestments, ending with a negative cash flow of $8.5 billion after goodwill. The capex to depreciation ratio was 209%, with 2019 and 2023 having the highest ratios and the lowest being in 2020. Again, probably due to COVID, and then 209% ratio indicated or signaled growth for RCL. Next slide. In terms of losses, they had non-operating losses of about 180 million and non-operating asset losses of 290 million, and again, resulting in a negative $9 billion owed to investors. Looking at where that money came from, they paid out $5 billion in interest and borrowed about $11.5 billion over the 5 years, majority borrowed in 2020. And they increased some minority interest in businesses in 2019 and 2020. They stopped dividend payments in 2021 and issued about $3 billion worth of shares over the 5 years. And now I'll pass it on to Julie to talk about multiples.
Despite Carnival's growth rate being higher than Royal Caribbean at 8.83% compared to 5.21%, Royal Caribbean is trading at a premium at 11.76 compared to 9.71. Drivers are high spread at 10.29% compared to 6.2 of Carnival's. Royal Caribbean also has a lower risk based on the cost of equity at 11.7 compared to 12.8. Royal Caribbean is trading at a premium at 11.76 compared to 8.6 for Norwegian. Royal Caribbean has a higher spread, 10.29%, and a higher growth at 5.21% compared to Norwegian at 9.21 in spread and 1.23 in growth. Royal Caribbean also has a lower risk based on cost of equity at 11.7% compared to 14.8%. Next slide. Royal Caribbean is trading at a premium to Carnival at 13.32 compared to 13.01. Although Royal Caribbean's WACC is higher at 9.7% versus 9.4 for Carnival, which generally would be a negative factor, Royal Caribbean has a higher spread of 14.67 compared to Carnival of negative 2.75, which indicates that it's creating value above its cost of capital. The positive long-term growth rate of Royal Caribbean at 4.52% compared to Carnival's negative growth rate at negative 11.12% suggests stronger future growth expectations. The difference in tax rate is 0.1%, so it does not have a significant impact. Despite Norwegian's WACC being lower than Royal Caribbean at 8% compared to 9.7%, Royal Caribbean trades at a premium compared to Norwegian at 13.32 compared to 12.60. This is due to the higher spread for Royal Caribbean at 4.67% compared to 0.12%, along with a higher long-term growth rate at 4.59% compared to 3.04 for Norwegian. Again, the difference in tax rate is 0.1%, so it does not have a significant impact. Next slide, please. Royal Caribbean is trading at a premium to Carnival at 3.43 compared to 1.83. Royal Caribbean has a higher margin at 25.8 compared to 14.1 of Carnival. It is more productive at 1.79 compared to Carnival at 2.11. The higher margin and higher productivity explains the higher ROIC of 14.37 for Royal Caribbean compared to 6.65%. Royal Caribbean's positive growth rate at 4.59% compared to Carnival's negative growth rate at negative 11.12% also suggests better future prospects. Royal Caribbean trades at a premium compared to Norwegian at 3.43 compared to 2.01. Royal Caribbean has a higher margin at 25.8% compared to 16% of Norwegian. It is more productive at 1.79 compared to Norwegian at 1.96. Hence, Royal Caribbean has the higher ROIC at 14.37% compared to 8.12. Royal Caribbean is also growing at a higher rate at 4.59% compared to 3.04 for Norwegian. Now I'll pass it over to Wade to go over valuations.
All right, for the as is, RCL's WACC is 9.7% with 257 million shares at about 155 each. The market forecasts an EBITDA margin between 35.4% and 36%, with a perpetuity EBIT margin averaging 26% in 2029. The EBITDA margin is 36.5%. RCL incorporated in Liberia pays no corporate taxes. The market assumes a 5.34% growth rate and a 6% revenue growth rate in 2029. Next slide. In our bull scenario, we assume personal income tax cuts are renewed, inflation is under control, and the Fed reduces interest rates to prevent a recession. This stimulates economic growth and consumer spending. With cruises booked 2 years out, consumers save more and spend more on board. New ships, technology upgrades, and expanding destinations drive growth. RCL focuses on premium services and invests in alternative fuels like LNG and fuel cells. With better fuel efficiency, we expect a 27% perpetuity and 37.5% EBITDA along with 8% revenue growth in 2029 and a 6.2% growth rate. This results in a share price of about $200, a 30% increase from the as is. Next slide. In the bear scenario, we assume the tax cut expires, inflation and interest rates stay moderate, and consumers have less to spend on vacations, even with rate cuts. Technical delays in new ships and technology upgrades lead to fewer bookings and less onboard spending. EBITDA drops to 31.5% with a 21 perpetuity in 2029. High maintenance costs and long dry dock times reduce RCL's competitiveness, pushing consumers to cheaper alternatives. With a 3% revenue growth in 2029 and a lower growth rate of 4.5%, our bear model gives a share price of about $81, a 40% decrease from the as is. Next slide. Finally, looking at our target, we assume the tax cut expires, inflation and interest rates are lower, while onboard spending remains moderate. New ships and upgrades are on schedule, but competitors challenge RCL's growth. The premium brand supports margin while fuel efficiency plateaus and higher fuel costs. The first LNG ship meets its major maintenance after 5 years of service, increasing costs. With 7% revenue growth in 2029, we expect a slightly higher 5.5% growth rate. EBITDA is 37% with a 26.5% perpetuity in 2029. This results in a share price of $168.22, a 9% increase from the as is, signaling a hold. And with that, I'll pass it over to Niraj.
So our rationale is basically that Royal Caribbean has shown strong recovery and growth potential post-pandemic because of increasing demand for leisure travel and the company's initiatives of expanding fleet and enhancing guest experiences. However, as you can see, there are like positives and negatives. Like RCL has a great spread of 5% versus the industry spread, which is giving it's giving competitive edge in fuel efficiency and technology upgrades. Even the capex to depreciation ratio is great for around 209%, which is also indicates consistent investment in growth. Plus, like RCL has invested strategically in and increased its minority interest, like also purchasing Silver Sea Cruises in last year, which enhances its market position. But with all these positives, there is already some headwinds, it's facing increasing competition from its competitors. Plus, the maintenance cost of LNG ships is questionable. So our rationale is basically that even though RCL has strong competitive advantages and like solid financials, it's going to face a lot of continuous innovation and strategic investments to maintain its position, and therefore our recommendation is a hold. And with this, we conclude our presentation. If there are any questions.
All right, so team 7, you're up.
Thank you. Great presentation. My question is, since cruises are such a big climate liability, even with the new technologies, would you foresee this hurting them at all due to restrictions or regulations?
Yeah, that's definitely a challenge, but they're heavily, because fuel is like their most expensive cost, and so they're actually doing a lot of research R&D behind the scene, because they you can see they roll out the newest icon of the seas, and then Utopia, they're powering by LNGs. They're looking into hydrogen fuel cells, and also as well as like waste to energy all sorts of technology. But yeah, so I previously also worked for Coast Guard, and I noticed like a lot of these technologies, like they don't have regulations. So like, you know, because usually regulations are behind of all the technology, right? So there's definitely some challenges. Like I foresee, you know, especially like on the maintenance side of the house, they don't know like how expensive it's gonna cost. So that's why I did include that in our target model. Thanks.
Kind of going off of that on the other side of, sorry, Chris, on the other side of the climate conversation, you know, you mentioned Icon of the Seas. Their itineraries have actually been changed due to like severe weather recently. So outside of the ships, how do you foresee, or did you take into consideration climate change affecting itineraries and operational costs over the next 5 years or in the future?
Yeah, I can talk about this one. Yes, like yes, like if, for a short answer, like that is going to be a huge factor. And I can go back to the, sorry, just to figure out how to go back on this. I can go back to our as is target. Sorry, if I can get this to work. Model. So in short, yes, like it changes like in the environment in the long run. I don't see a huge impact potentially in the next 5 years, but definitely if we're looking like 10, 20 years in the future, we could see a very huge impact from the environment as routes change. Right now, one of the biggest growing sectors right now is actually Alaskan cruises, which there's actually been a lot of local regulations for a lot of the peers there from like the locals having concerns about the environmental impacts as well as some glaciers and flooding. So those could see an impact as well. Which is why we still foresee the cruise line increasing just due to the fact there's so much of a market share that they're going to be able to capture. But yes, like that, the change in the environment, both from a public perception as well as an actual impact, as you're saying, like on their cruise line, like on their schedules, hurricanes, etc., could have a factor in the revenue growth rate and growth rate in the future.
Great. Hey, if climate change raises the sea levels, maybe we will all be living on cruise ships, and that'll be a boon to their business. So could go either way.
I had a
Just
quick
to
question.
Yeah, go
Sorry, I
ahead.
just wanted to add one more point to that. To mitigate that risk, I believe they do have like in-house metrology and things like to SMEs to kind of look into that instead of relying on what we are relying on. So I think that's one aspect that could also protect them from that risk. It won't eliminate it, but yeah.
All right, question for you guys. Looking at all three companies' stock prices, it's clear the pandemic caused the largest drop in their share price over the history of all three. From the pandemic lows, Norwegian bounced back 83%. Up till today, Carnival bounced back 80%. But Royal Caribbean rebounded 567%. You guys know what they did differently to achieve such a strong rebound compared to the other two?
A lot of what I read for the EIC analysis was that their ports, like their actual destinations, were differentiated compared. They're a lot stronger in like, I don't want to say like the American market, but just not the Asian market particularly. But how they've been able to stand out primarily has been their ability to offer different opportunities than the other cruises have that differentiated product, as well as a lot of their acquisitions recently of having expanded to like the high-end luxury market as well. So some of those have also helped build it up. My rest of my team can help answer that as well if they have anything else to add.
Yeah, that was good. I was just curious. That was a big rebound for those guys compared to the competitors.
So,
Hi, guys. Oh, go ahead.
Yeah, I was just going to add like some of the like they are kind of little bit strategic in their decisions. So they kind of like sold off their old cruise ships to like newer emerging companies. Plus, they have also been like aggressively targeting emerging markets in Asia, like India and China. Like they're targeting the middle class out there because they are into cruise vacations and all. So they have been expanding in like that. Plus, they also bought like the one of the things that we mentioned, the Silver Sea cruises, which is actually like ultra luxury cruise, like I guess basically cruise vacation ships. Silver Sea used to have, and it already had cornered 26% of the market of ultra luxury travelers, and like that's what they purchased, and they have been increasing minority interest in like a lot of like smaller companies like that. So that's what they have been doing since 2019, and 2023 was when they purchased Silver Sea, plus like fleet cut downs that they are doing, and plus they also improved like Icon of the Sea and like newer ships. They're implementing LNG, so they are reducing dependence on like oil basically, and like emerging markets. Those are like multiple I guess like parameters that is driving their rebound.
Okay, well, thank you, Royal Caribbean, and the good Q&A. Let's move on to waste management.
Great, that's us. All right.
All right.
Good evening, everybody. I hope everybody is prepped and ready to talk about trash or waste management. So just as an intro, we're recommending a buy on waste management with a target price of $271.41 versus their current price of $205.40. Starting off with the peer betas, I'm going to be referencing these in my next slide, so just want to take a moment here to display them. It's just a blow up of the Bloomberg screenshot because it's a little blurry. Just want to make sure y'all can see it. So the industry's raw and adjusted betas of 0.47 and 0.65 respectively suggest that the industry overall is less sensitive to market movements than the overall market. And that's likely due to the essential nature of waste services. Services are always in demand regardless of economic conditions. Waste management follows that trend. Their raw beta of 0.37, which obviously since significantly lower than 1, follows that trend, indicating it's less volatile than the market. And two of their peers, Waste Connections and Republic Services, with their betas as displayed here, seem consistent with the overall industry's low economic sensitivity. Another blow up of the Bloomberg screenshots. We'll be referring to these on the next few slides. Just wanted to present these before we move forward. Talking about the industry 5 forces, for threat of new entrants, there are currently high barriers to entry. There's a need of significant capital investment. There are regulatory requirements and a need for economies of scale. And in the future, over the next 5 years, the industry may see moderate changes in the threat of new entrants due to some technological advancements in waste processing and recycling, which could lower barriers, but stringent environmental regulations and the need for expansive infrastructure will likely to continue to deter new players. For bargaining power of suppliers, the peers ROIC and WACS, as displayed here, indicate that the industry generally overall has strong financial performance and operational efficiency, and those kinds of factors do allow large firms to negotiate favorable terms with their suppliers. So as waste management firms continue to consolidate, which we'll touch on a little bit in a moment here, supplier power may decrease further, which is giving us the low to moderate rating there. Customers, which include generally municipalities and large industrial clients, do have some bargaining power just due to the availability of multiple service providers in some regions. But since waste management is an essential service, it does mitigate this power to an extent. And it's likely to remain moderate in the future with a potential increase in influence as demand for specialized services grows, like environmentally friendly waste processing, but we're forecasting that that will continue to remain moderate. The threat of substitutes currently and in the future will remain low. There are very few alternatives to professional waste management services. Waste reduction and recycling initiatives could technically be seen as substitutes for waste management, but they're generally seen as complementary rather than complete substitutes. So we see that remaining low in the future as it is now. The industry's average WACC of 7.03 with a slightly higher ROIC at 8.76 indicate that while the industry is currently profitable, their margins could tighten in the future, which would lead to increased competition. Currently, the industry is characterized by a few large players that have significant market shares. So there's currently a moderate rivalry, which is only expected to increase as companies start to focus on sustainability, innovation in technology, and just differentiation in their services. So the pressure to maintain and increase ROIC while managing costs will likely drive further competition. Just bringing those numbers back to everyone's attention as I go into some competitive advantage analysis now and in 5 years. Waste Management acquired Advanced Disposal Services and has a pending purchase of another organization called Stericycle. And under the current CEO's tenure, Jim Fish, there's been a 60% increase in EBITDA. And those strategic acquisitions have solidified Waste Management's dominance, which is allowing it to achieve significant economies of scale. They control 27% of the North American solid waste market, and that fact supports their cost efficiencies and strengthens their pricing power. They have an ROIC of 12.64% and a WACC of 6.79%, which, as I touched on previously, obviously highlights their efficient capital allocation and their strong financial health. And that stability and health enables them to pursue further growth opportunities without potentially jeopardizing their competitive position. They have a strong pricing power. Their collection and disposal yield increased 4.6% in 2023. They actually, because they own many landfills and have a large landfill base, that further enhances their pricing power. They can command higher prices for their waste disposal services since they own the landfills as well. They have current sustainability investments, which I'll touch on again in the next slide regarding future competitive advantage. But those current investments are expected to generate an additional $800 million in EBITDA, $500 million from renewable energy, and $300 million from recycling. And those initiatives and current investments are not only aligning with global environmental trends, but are also providing Waste Management with a competitive edge as their customers start to prioritize sustainability. As I mentioned previously, there is a pending acquisition of Stericycle, which is, further consolidating the industry. Stericycle's expertise is in regulated medical waste and secure document destruction, which is going to open new revenue streams for Waste Management. Waste Management is investing in automation, and by 2026 plans to have 43 automated material recycling facilities. And they also have a renewable natural gas RNG initiative, which is expected to generate $500 million in EBITDA by 2027. The initiative is converting landfill methane into renewable natural gas and using that gas to power its own fleet. So this will reduce operational costs and also position the company as a leader in sustainable waste management. So their proactive approach is to reduce their greenhouse gas emissions 42% by 2032. And achieving these targets will require substantial investment in fleet conversion and renewable energy, but in the long term will provide cost savings and compliance benefits as regulations become stricter.
And looking at the ROIC tree, the overall 5-year change is negative 6.3% from 10.5 in 2019 to 9.8 in 2023, which of course is unfavorable for the company. And then the end of year pre-tax ROIC only changed negative 1.3% over 5 years from 13.2 to 13%. This can be explained by breaking down the first level, starting with the tax rate at 20.6% in 2019 and increased to 24.7% with a 19.6% change, which is also unfavorable to the company. And then looking at the operating margin, it starts and ends at 17.5 cents. So there's no change there. And then productivity, slight decrease, 1.3% from $1.33 to $1.34. So they spent 1 cent more on every sale. And then looking at the second level, starting with the income statement aspect, the gross margin change of negative 0.7% hurts the operating margin, but the SG&A change of negative 1.3% 0.6%, and the depreciation change of negative 0.4% is favorable. But these cancel out, leaving us with a 0% change in operating margin. Looking at the balance sheet aspect, operating working capital to sales went from positive 0.7 to negative 0.1 cents, which is favorable since negative working capital lowers your investment. However, only a less than 1 cent difference, so it's not a big driver, even with a negative 112.7% change. PP&E to sales went from 86.2 to 85.3 cents, which is 1% less. So they're spending almost 1 cent less on PP&E per sale. And then looking at goodwill, went from 45.6 to 49 cents with a 7.4% change, which is unfavorable. Considering this is a relatively stable company, goodwill is the largest driver when included, with a 3.4% increase driving invested capital per sale from $1.33 to $1.34, which led to the pre-tax ROIC dropping from 13.2 to 13. And then combined with the increased cash tax rate of 20.6 to 24.7%, hurting them, the company's overall ROIC from 10.5 to 9.8%. Not shown here, but to add to that, there is a small change without goodwill that would cause the invested capital to sales to decrease to negative 1.9% change because operating working capital and PP are favorable. This is good for pre-tax ROIC and brings the overall ROIC up to negative 3.3%, change from 16 to 15.5%.
All right, and then looking at the historical analysis over the 5-year span of 2019 to 2023, they had a total gross cash flow of $20.9 billion. They reinvested 14.6 back into the business, which equates to a 70% reinvestment rate. Ultimately, they remained with a $6.3 billion of free cash flow, excluding goodwill. One thing to note is that in October of 2020, they acquired Advanced Disposal Services, as Claire mentioned, which was based in Florida for $3 billion, which ultimately reduced their total 5-year cash flow down to $3.3 billion. On average, in that time frame, they're spending roughly 160% in CapEx compared to depreciation, which is a signal of expansion. The yearly average was very consistent with the exception of 2021, which was a result of the previous pandemic year when revenues decreased by 11% roughly. The total cash flow available to investors over the last 5 years was $3.7 billion, and this began with the $3.3 billion of free cash flow. They had a non-operating loss of $300 million, and after-tax income from affiliates of $221 million, and an increase in excess cash of $286 million. And then finally, a $1.16 billion decrease in non-operating liabilities. Their $3.7 billion of cash flow available to investors was first allocated towards after-tax interest expenses that totaled $1.6 billion. They took on new debt of $6.8 billion, paid out $4.9 billion in dividends to shareholders, and then repurchased roughly $4 billion in shares. And the increase in debt was attributed to the distribution of dividends. And now Taylor will talk about the multiples.
So as for PE, at first glance, we see that Waste Management is trading at a discount to both Waste Connections and Republic Services. We're first going to focus on Waste Management and Waste Connections. Although Waste Management has a bigger spread at 23.2%, it's creating value at a slower growth rate than Waste Connection. That's 3.9% versus 4.92%. Waste Management also has a higher risk by 0.30%. Moreover, the biggest key value driver impacting Waste Management is its growth rate. If I were to match Waste Management's growth rate to Waste Connection, the PE would shoot up to 39.24 and would thus make them the premium traders. But that's unfortunately not the case here. Next, looking at Waste Management compared to Republic Services, although Waste Management has a higher spread by 13.4% and a lower risk by 0.4%, these factors do not create a big enough impact to overwhelm Republic Services' growth rate of 5.35%. If I were to match Waste Management's growth rate to Republic Services, Waste Management's PE would shoot up to 42.29, thus making them the premium traders. But again, that's not the case here. On to EV to EBIT. On an enterprise value basis, Waste Management is trading again at a discount to both Waste Connections and Republic Services. So first, focusing on Waste Management compared to Waste Connection, Waste Management has a higher spread at 6.30%, but is creating value at a slower growth rate, higher tax rate, and higher risk. Similarly, when compared to Republic Services, Waste Management again has the more favorable spread and lower risk, but is creating value at a slower growth rate and higher tax rate. The biggest impact in both of these scenarios is Waste Management's growth rate. If I were to match Waste Management's growth rate to Waste Connections, leaving all else equal, Waste Management's EV to EBIT would shoot up to a whopping 84.47. If I were to match Waste Management's growth rate to Republic Services, leaving all else equal, Waste Management EV to EBIT would shoot up to 31.80. Lastly, on the EV to revenue, Waste Management, again, is trading at a discount to both Waste Connections and Republic Services. So first, looking at Waste Management compared to Waste Connections, first, Waste Management has a lower pre-tax margin by 0.5% and a lower after-tax margin by 0.8%, both of which are less favorable. Although Waste Management is spending $1.14 less to drive $1 of revenue and has a higher ROIC of 6.1%, which are both favorable to the company, the better productivity and ROIC numbers aren't enough to overwhelm Waste Connections' higher margins. Lastly, if we're to compare Waste Management to Republic Services, we see that Waste Management and Republic Services are nearly identical in their pre-tax operating margins, but Waste Management has a lower after-tax margin by 0.5%. To drive $1 of revenue, Waste Management is spending 38 cents less than Republic Services. And lastly, Waste Management has a higher ROIC by 2.84%, which also benefits them. But ultimately, again, the better productivity and ROIC numbers for Waste Management aren't enough to overwhelm Republic Services' higher tax margins, thus making Republic Services the premium trader.
All right, so looking at the as-is valuation, the current share price is $205.40. In order to match that, the assumptions that we made were a 4.5% revenue growth rate, which we thought was very reasonable given the industry that they're in. We kept the EBITDA consistent with the projected average of the next 5 years, which was 31%, which then kept the operating income consistent at 20.9%. We also kept the tax rate similar to 2023 at 24.7%, being conservative there. And given those assumptions, we concluded that the forecasted CV growth rate would need to be 4.47%. And now Dane will talk about the bull scenario.
As it relates to the bull, Waste Management has a favorable industry position, being the largest solid waste company and landfill operator in North America, which represents over 25% of the $80 billion North American market, and they're also of good financial health. Therefore, we increased the growth rate from 4.47% to 5%. We also predict a revenue growth rate increase from 4.5% to 7.5% due to projected profits from sustainability projects in 2024, such as building renewable gas plants, recycling and expanding their facilities, acquisitions in new geographies, tech automation, and their Stericycle deal, in which this acquisition's earnings and cost savings are expected to outweigh the borrowing costs. Therefore, we increase EBITDA from 31% to 33%. Also, based on JP Morgan's tax rate range of 22% to 24%, we decreased the tax rate from 24.7% to 23.5%. Given the above changes, the new share price can be as high as $317.43. For the bear, we revised Waste Management's revenue growth rate from 4.47% to 3.9% because of increased cost pressures, especially in labor. This might lead to lower profit margins if the company cannot raise prices fast enough. We also lowered the EBITDA from 31% to 29% due to heightened regulatory risk resulting from the extensive landfill network and increased insurance costs from safety accidents. Revenue also reduced from 4.5% to 4% due to competitive pricing in the industry, which could result in lower prices or reduced sales volume. and there can also be delays in their projects, which could postpone expected contributions. The tax rate was increased from 24.7% to 27.5%, based on Bloomberg's equity research, which anticipates a 6% interest rate on their new debt and a 27.5% tax rate, which is consistent with the Stericycle's acquisition standalone guidance. The new share price can be $133.77. Lastly, the target waste management investments are expected to generate about $300 million in yearly revenues. And since being under new management, the company's revenue increased by 45%. As a result, the growth rate has been risen from 4.47% to 4.8%. Their new renewable gas plants and expansion into new markets will help the company benefit from economies of scale and operational synergies. Because they also aim to address labor challenges, they can capitalize on new renewable energy opportunities, resulting in improved cost structures and higher profitability. This led to an increase in EBITDA from 31% to 32.5%. Their large landfill base provides a competitive advantage, giving the company more control over prices charged for collection services, which accounts for over 60% of their total revenue. Therefore, revenue has increased from 4.5% to 7%. Additionally, the tax rate has been reduced from 24.7% to 24.5% based on JP Morgan's analysis. With a target share price of $271.41, which is more than the current share price, we recommend to buy. In conclusion, while Waste Management is the largest company in North America, they are still trading at a discount to their competitors because of their growth rate. However, given their sustainability investments, economies of scale, effective leadership, and being less sensitive to the market, they can attain their target EBITDA and revenue grade, hence the decision to buy. Thank you for listening to our presentation. We now open a room for questions.
Thank you, Waste Management. Team 8, you're up with your Q&A.
I have one question. Compared to its competitors, I think you did Waste Connection and Republic Services. If you could only buy one, which one would you buy and why?
I'll take that one. I would buy Waste Management because they are the behemoth in the market. Even though their growth rate is slightly lower than the other two, they have such a stronghold on the market, and they're continuing to invest. Their CapEx to depreciation or their reinvestment rate was 70%, with a 160, what was that number? They're continuing to buy more and more companies to expand. You can scroll back. But my answer for you would be Waste Management there, even though they are trading at a slightly discounted multiple.
Thank you. I will buy.
Do you fear, though, that because you're trying to do expansion and trying to invest in new things like sustainability, because all those projects that you say, like $800 million is kind of coming in through revenue, do you fear that that could mess with the market, even though they have the majority share of their industry?
I personally don't think so. They have such an expansive infrastructure with their landfills and their just general dominance. You see WM on every other dumpster, which branding, yay. But I think the progressive need for sustainability and all the investments they're making in, I don't personally think that that's a negative and that would affect them negatively. Did I answer your question?
Yeah, you did.
Probably not. Okay.
I have a quick question regarding the strategy of specifically, I guess this refers back to the EIC more than anything. Whether or not they consider or they have considered including electric vehicles in their fleet, and the effect of legislation specifically on these trucks, which I think are mostly powered.
Yeah, so I think from what I understand, their focus is on that RNG initiative where they're taking the gas the methane from their landfills and turning it into gas for their fleets. I am not recalling anything particularly about electric vehicles because they are investing in a different alternative energy source there. But if any of my group members understand differently, feel free to pipe in.
I've got another question, probably goes back to the EIC as well. I know in like the last 5-10 years, a fair amount of like Asian countries, including China, no longer accept our recycling and waste exports. So I was curious if any of that came up in terms of waste management, changing strategies and like how that would have impacted their finances and such.
Transparently, it did not come up.
Got it.
But a good thing to consider.
Yeah, it might have been a little bit before like the timing of this, so no worries.
I will add to that. I'm pretty certain they only operate in the US and Puerto Rico and Canada as well.
Got it.
I have a question. Is the labor force for waste management unionized? And if so, do you think there will be any impact to like EBITDA from collective bargaining changes or increases in minimum wage?
I don't know if they are unionized across the entire corporation. As far as I know, unions operate in smaller geographic areas.
Yeah, there is a Teamsters contingency at Waste Management, but it didn't come up in our review of the organization.
Right, thank you.
I have one last question, which is, and perhaps you mentioned it, but what's the primary driver of your adjustment of the revenue growth rate in your target model?
Can you go back to that slide, please? Target. We increased the revenue to 7% because of their large landfill base, which gives them a competitive advantage. They can increase their prices, which will increase the volume of sales, and also their multiple investments they've made in sustainability and the acquisition of Stericycle. So.
Excellent, thank you.
And that brings us to time. Thank you, Waste Management and the investment committee team. We have one team left, and I'll ask, do we need a 5-minute break or do we want to push ahead?
Let's finish this up.
Let's do it.
All right, Adobe, you ready?
Yes, we are.
Yes.
Yeah, sorry, I was on mute. Give me 1 second and I will share my screen.
I was gonna say, maybe we do need the break then. If you're ready, Adobe.
Yeah, it should be queuing up right now.
It's on the screen.
It's on the screen. Just present.
So all right, so we're doing Adobe. Team is me, Adam, Glow, Marcos, Raymond, and William. And I'll let Ahmad kick us off.
All right.
In present.
What did you say?
Is it not?
No.
It is in present.
All right, might be slow to do.
I guess we'll just do it like this because it's not cooperating.
Okay. All right. So with that being said, thank you, John. So we are Adobe. Our analysis or recommendation is to sell. Current price is $535 right now. Target price is $395, which is why we are considering selling. Go ahead, next slide. EIC. So economy at this moment in time, the industry beta or the beta at this point is 1.31, which is a moderate volatility within sensitivity in the market. Adobe, well, that is the industry standard, but Adobe standard is 1.9. So really highly sensitive to market changes. Also our other two, Autodesk and Intuit, we found are 1.7 and 1.5 respectively. So very closer, or they are closer to the industry, Adobe being the leader as far as high sensitivity. Next. Like I just said before, strong economy, Adobe revenue could grow to 15 to 20% annually, with stocks gaining 1.5 faster than the market. Downturn, revenue growth could slow to 2.5 to 2 to 5%, sorry, with the decline of that 1.5 going faster than the market. And then a stable economy, steady revenue can grow as high as 12% with a stock performance in line with the market. Industry factors are AI heavy, price increase, supply chain, any conflicts, be it geopolitical or any type of policy on AI, and then also the election with any type of taxation or regulations that have come to. Go ahead. And I'll pass on.
Thank you, Ahmad. So I'm going to jump into the Porters by Forces. So the threat of new entrants is low, and that's mainly because of the high barrier due to substantial R&D costs and their strong brand presence. In regards to their bargaining power of supplies, that is also low, and that really has to do with suppliers have limited power due to the commoditization nature of inputs and Adobe scale. In regards to their bargaining power of buyers, that we said was moderate, and this is really because buyers have a moderate power due to their ability to select other alternatives. And threat of substitute is also moderate. Again, alternatives do exist, but Adobe does have that comprehensive product to kind of mitigate some of that risk. And industry rival is high. Competition is fierce among established players like Autodesk and Intuit. Next tab, please. Okay, and in regards to the future, the next 5 years, threat of new entrant is still low because the industry requires continued high investment in technology and brand development. The power of suppliers is still also low as Adobe grows. It actually strengthens its negotiating power. And the bargaining power of the buyers is moderate. Buyer powers might increase as more competitive and affordable alternatives emerge, potentially pressuring Adobe on pricing. Threats of substitute, that one is also moderate. The threat may rise with the advancement of AI-driven tools and more sophisticated open source software. And lastly, the industry rival is it's high and likely to intensify as new entrants and technological innovations drive market dynamics. Next tab, please. So in regards to the company, they do have a competitive advantage when it comes to their company as a whole because they do have a high ROIC. Which is almost double the industry standard. They do have a higher WACC that's higher than the industry standard. However, with such a high ROIC, it's almost minimal. 5-year outlook, again, continuing their innovation in AI to strengthen their product line, they'll be able to sustain. And it's cut off on my end.
Risk will be rising competition or market shifts that could challenge Adobe's ability to maintain the positive spread. And their strategy focus, wise investments will be key to ensure the ROIC stays strong despite potential whack. And then obviously the industry context, ROIC versus the whack abilities, Adobe's ability to achieve a higher ROIC than whack is clear. Indicated that the competitive strength in comparison, other industries players might struggle to maintain that same spread, as you can see. Go ahead, next slide.
So historical analysis, Adam's going to kick us off with the ROIC key drivers.
Adam, you're on mute.
Sorry about that. So we have an increase of 68.5 of the ending of the year ROIC. Moving to their pre-tax, it's a 94.3% increase. We're going to move all the way over to our depreciation, which is a decrease of 33.7%. This is mainly because of the revenue growth, which has grown over 2 billion average over the past 5 years. The depreciation has only increased about 300 million over the past 5 years. So that main decrease is because of the revenue growing so fast, which makes the operating margin with a 17.1% growth. The cash rate tax, the biggest thing to really pay attention to here is in 2020, they had a negative 26% tax rate. This was a one-time only thing. It was because they had a change of intellectual property that went to one of their subsidiaries, which led to a 154.4% increase or change over the years. Their invested capital is at 39.7%, a negative 39.7% that changed over the years. This is mainly because of the intangibles over sales. Once again, this is because of their revenue change over the years. Their intangibles only changed by $1 billion over the entire 5-year process. So the revenue growth really helped make that a negative number since it is based off of the revenue sales. So moving on to John with the CFI.
All right, so for the CFI, as you can see, Adobe's gross cash flow increased from 3.7 million in 2019 to 6.2 in 2023. There was a small dip in there in 21 and 22, but they've since rebounded. And then their free cash flow has also been strong, but a bit volatile due to fluctuating investments, mainly in goodwill and intangibles. Their reinvestment rate varied as well, the low of 5% and a high of 26%. The lower rate in 2021 of 5% is due to their M&A activity that year. Adobe acquired a few companies in 2021, including Frame.io for 1.3 billion. Essentially, Adobe's used a combination of its free cash flow and some minor debt financing to fund its aggressive share repurchases over this 5-year period. Their ability to repurchase shares even in years with lower free cash flow suggests a strong excess cash position to pull from and confidence in the company's long-term financial health. And then also I thought of that was something that was of note was Adobe not offering any dividends. So essentially the main way they give back to their shareholders is through share repurchases and increasing their company value. So moving on to the multiples analysis, I'm going to cover the PE ratio, the EV to EBIT, and EV to sales. Starting off with the PE, Adobe's trading at a discount to both Autodesk and Intuit at 26.01. If you look at their ROE at 25.3%, kind of falls in the middle of the pack. They do have the highest cost of equity at 13.7%. which leads to a spread of 11.6%, which again falls in the middle of the pack. Well, they do have the highest growth rate in net income at 11.6%. Their lower multiple is due to their middling ROE and higher COE, and Adobe having a significantly higher net income than its competitors. Moving on to EV to EBIT, Adobe has Adobe's trading at a discount compared to both its competitors, with 21.29. Their ROIC is 24.5%. It's middle of the pack, which suggests they are less efficient than Autodesk, but more efficient than Intuit at generating returns. Adobe, again, has the highest weighted average cost capital of 3 companies at 13.4%. And the spread between the two, Adobe has 11.1%, which suggests they, again, are less efficient than Autodesk, but more efficient than Intuit at creating value relative to their cost of capital. Adobe does have the highest growth rate of the 3 at 11.3%, and the lowest tax rate at 18.5%. But even with that, their valuation is still negatively impacted by their high WACC and their middling ROIC. And then moving on to EV to sales, Adobe's trading at a premium to Autodesk and a discount to Intuit at 9.84. Adobe has the highest operating and NOPAT margins of 3 companies at 46.2% and 37.7%. Their productivity ratio of 1.54 also leads their competitors, which shows how much invested capital is required to generate sales. ROIC and WACC also come into play with this ratio in a similar way to EV to EBIT, but basically the main drivers behind their EV to revenue ratio being in the middle of the pack is their high operating and NOPAT margins and productivity, and they're being offset by their middling ROIC and their their high WACC. And I'm going to pass it off to Raymond to talk about our as-is and bear models.
Okay. In our as-is valuation, the revenue growth rate is projected at 14.3% based on forecasts extending through 2029. The EBITDA margin has been set to 50.71% to align the operating income between perpetuity EBITDA margin of 46.22% and 46.21%. The corporate tax rate is averaged at 16.5%. This is derived from guidance provided for the period between 2020 and 2024. Based on these factors, we've backed into a CV growth rate of 9.67%. This growth rate, combined with other assumptions, leads to a share price of $535.22. In our bear model, the revenue growth rate has been lowered by 56.2% from 14.3% to 6.3% to reflect the potential impact of heightened competition and the rising threat of substitutes in the industry. We also trimmed the EBITDA margin by 2%, reducing it from 50.71% to 49.7%. The adjustment considers the possibility of increased pricing pressures and growing bargaining power of buyers, which could erode Adobe's margins. The tax rate has also been increased by 21.2% from 16.5% to 20%, reflecting the potential for policy changes under new government leadership. Lastly, we reduced the perpetuity growth rate by 17.27%, bringing the EV growth rate down from 9.67% to 8%. The adjustment is based on the expectation that industry rivalry will intensify and make it more challenging for Adobe to sustain its previous growth trajectory in the long term. So in our bear scenario, we estimate that Adobe's stock price could fall to $353.37, representing a potential decline of 33.98% from the current level of $535.22. And now to Marcos to discuss our bull model.
So in our bull model, we were very optimistic in regard to the continuing value growth rate. We increased it about 7.91% from 9.67 that was seen in the as-is model up to 10.5 to meet the growth that was predicted from the bull scenario and sort of aligned also with our EIC. This could be driven possibly by Adobe's model that's centered around creative users. We predict that it's going to grow in this scenario. The revenue, in regard to our revenue growth rate, we also, as Adam stipulated in the ROIC analysis, they saw increases in revenue growth rate. So we decided also to raise our revenue growth rate from 14.3% to 15%, which did not really affect the valuation of the firm as much as the growth rate did, but we decided to use that for our bull scenario. In regard to the EBITDA margin, we left it the same. Why did we leave it the same? Because we estimated that was probably the cap that the EBITDA would hit in this instance, considering Adobe's previous performances. And looking forward, we didn't really think that was going to change much. In regard to tax rate, we decided to drop it from the as-is. In the as-is, the corporate tax rate was 16.5%. We decided to drop it to 16% due to changes in the presidential administration and outcome of the elections. In regard to the balance sheet, there was no change. So that left us with our final forecasted share price of $669.66 and a percentage change from the current share price of 25.12%. And that leads us to our target model, which Will give us.
Thanks, Marcos. I think we're running up on time, so I'll try to make this quick. Ultimately, we think Adobe appears just slightly overvalued. We think the perpetuity growth rates presented here in this slide are unlikely sustainable at such a high margin. So that's why we chose to take it down to 45% from the 50% in the as-is. We expect that in order to continue to expand market share and achieve as high of a revenue growth rate as possible, they'll have to take a slight hit in their margin, which is still healthy to say the least. Ultimately, in the as-is model, Adobe's financials reflect sort of a constant in their operation investment, but we believe in order to maintain or mitigate the risk of buyer power and substitutes in the market and in the industry as generative AI, which is driving a lot of their product innovation, continues to accelerate, they're going to need to take an EBITDA cut and reinvest in OIC. So given that we don't think Adobe is likely to maintain a 15% growth rate, we adjusted that down to 10%. And we also shaved off the continuing valuation growth from 9.67 in our as-is to 9%. And we assumed the tax rate would, in perpetuity, stay at 18.5%, leading to a share price of $395.36, representing a 26.13% decline from the current price. It's important to note that Adobe is particularly sensitive to its growth rates, given its ROIC that is significantly high for the industry, and so that's why such a small change in the continuing value G can have such a, and the revenue growth rate will have such a negative impact on its target price. So we ultimately think the as-is is really optimistic with its perpetuity revenue growth rate, and that's why we recommend to sell.
Great, thanks, Adobe. Team 2, you can finish up our Q&A.
I'll ask a quick question about your target since we just went over it. Do you have any concerns about a 9% perpetuity growth rate? That seems fairly high. I don't know the industry, but based on an economy growth rate is 3%. That's 3 times the economy's growth rate every year for the rest of time. Do you have any concerns about that, or do you think that's accurate?
We think that's accurate because that's what we're seeing in the industry across the board, and considering Adobe's strong market position and current market share, being a premier product in the design software space, it's expected, especially since they have the head start on the inclusion of generative AI into their products. We think, though, that they'll be limited in terms of their revenue growth rate and in terms of their EBITDA in order to achieve such a growth rate overall. And if anyone from the team has anything else to add, please jump in.
Given your guys' kind of bearish projections, when I think of Adobe, I typically think of like document viewers, document signers. How do you think AI replaces those kind of more basic functions?
Our view is that AI will ultimately enhance those functions and make them incredibly necessary. To use Adobe, for example, if they have the market-leading document analysis and AI tools, there is a risk of cannibalization in that fact, though, because you won't need as many user licenses, because the automation that AI brings will increase the productivity of the end user to the extent that you won't need as many people employed to manage documents and things like that. So it's a double-edged sword.
Gotcha. Thanks.
I would also add that Adobe does provide products and services related to media and content generation as well. So it's not just document and productivity features that it provides.
Understood. And then looking at the company's beta, I think you had like 1.9 versus an industry of 1.3. Did you guys dig in any further about what the significant increase there was? Why is it so much more susceptible to the economy?
There's probably a good answer for that, and I'll let the EIC team answer that with respect to how the overall economy affects it. But something important to note is over the last 5 years, they did have this acquisition announcement, which has made the stock pretty volatile overall, and so that's probably contributing to that sort of higher beta. When the market was good and they announced the acquisition, it significantly outperformed the market, and vice versa when the market took a downturn. It was also in line with when they announced the discontinuation of the acquisition, so they got a double whammy there on both ends.
So yes, adding to William, it's a hard swing when the market is good and the economy is going good. The price is amazing. When we have a challenging year like 2022, that's when Figma, where the acquisition was announced, then kind of pulled back, then re-announced. Those kind of things make it really kind of kill the stock. So you see hard fluctuations.
Gotcha. Thank you.
Also, just to add to that point, Adobe's model is practically their target market is B2B, right? Business to business, people who do business, people who pay for subscription models. So that's why I would argue it's more susceptible to the economy, because as the economy gets better, you have more subscription users. As it gets worse, people start looking for ulterior options.
Yeah, so looking back at you guys' target value, just scroll back down to that. I just was curious how you came to the target EBITDA of 45%, just considering that in your bear and bull assessment, in your bear assessment, it's a relatively conservative loss of EBITDA margin, but it seems like it's pretty significant when you get to the target.
Yeah, that's a great question. 45% is the average over the 5 years, the coming 5 years, taken from the Bloomberg consensus. So rather than take it from the as is, which bumped it up to 50% in order to match the consensus EV to revenue multiples, we kept it as the average of the coming 5 years EBITDA expectations. I'll let Raymond jump in as to why we left the bear EBITDA where it was, but in our model for the target, we didn't use the EV to revenue multiples. We just used the coming 5 years consensus EBITDA.
Yeah, we just thought it'd be reasonable to project a decline in the EBITDA from the as is. Yeah,
I would add
that's
that in the
about it.
target model, we're not like the bearish model might be more, and Raymond, correct me, is it, you know, in a bear market, whereas we see the market fundamentals overall strong in the target, just that their EBITDA is going to take a hit in order to maintain a competitive advantage, despite them having a strong market position and a head start on a lot of the generative AI features that are drawing customers to them in the creative space with Photoshop and things like that. It's not sustainable to maintain a 9% continuing valuation growth or revenue growth rate of double digits without investing in OIC.
I think that's 5 minutes.
All right, that is our 5 minutes. Thank you. All right, thank you. Hold on 1 second. All right, I'm just entering in your grades. Okay, I think I put them in correctly, but basically, I just entered in your grades. 36 points is what was available for this presentation. 4 points will be the investment committee's assessment of you, which you'll turn in as the investment committee by Thursday, is what we agreed upon last week. See, just looking at the speed grader, see, already somewhat might have already done that so far tonight. Just kind of a 1-page assessment of the Q&A and what you thought about their presentation. But I have to say, overall, I was impressed. You guys all did a really, really good job. And I think in terms of following the process, I think you had some really good insights into what was going on with the companies and the industries. Also, I appreciated the investment committee questions. Many of them were kind of honing on the key issues for the companies and were relatively insightful in terms of what were going to be the risks and understanding some of the valuations of the companies. So I think it was actually a well done summary of what we have been covering this semester. I don't have too much to add, but I'll just ask, what did you guys think? You learned a lot about these companies?
Yeah, I definitely learned a lot, but as you know, you start hearing the same thing over and over again, it gets a little like repetitive to a certain point, but I did learn a lot, yeah.
Well, I guess in a way, from a process standpoint, that's kind of good. And you're starting to understand some of the key things that we're going to be looking at for companies. Any other thoughts?
I thought it was interesting just to see a holistic relation between the numbers and the actual story, the actual experience of companies, meaning the challenges, the victories, the sort of I don't know. It was just interesting to see it applied actually, and understanding the mathematics behind it a little bit, behind what drives value in a firm.
Yeah. Well, and you use the word story because I think there is a storytelling element to finance, and part of what we saw as you kind of progress through your presentations is a little connecting the dots with a story. So again, the numbers are not just in a vacuum, and we're kind of understanding the context of why they are, at least what they could be or what could change or drive them. And I think that's another very important element. I always use the word assumptions, but I think explaining the assumptions in the context of a story could be very useful.
I was just going to add that reverse engineering, if that's appropriate to call it, the as is, to figure out what is the market thinking, and what story they're telling is really helpful when then trying to go and put in your own assumptions.
I think a lot of people skip that step in the real world, and even when they teach in academic, people just kind of go right to the target models when they do valuations. And I think the as is could be instructive, because I think even from the perception of your teams, like a couple of you are like, wow, these seem, I'm paraphrasing, but these seem a little unreasonable to hit in terms of the numbers that would have to be justified to hit these target prices. And I think that's where a couple of the sell recommendations kind of came into play, which without the as is, as I said, it might not have seemed so unreasonable when you're kind of looking at some of these DCFs. So again, if you continue to do this, I think it's a useful part of the process. But it also just goes back to, we use the word reverse engineering, but it gets back to that law of one price in finance, meaning, there's got to be one value of a company. We can have different approaches to get to the value. They all have to kind of give you a similar result. And we should be able to work forwards and backwards because the cash flows are the price, then the price should infer the cash flows. And the same is true with the multiples. They should triangulate somewhat consistently. They shouldn't really give you completely different answers. All right. Well, again, I think today was a good summary. So again, I know a lot of work went into these, so I really appreciate that. And hopefully, as you put together the final presentations, it was reinforcing to all of the projects that we had worked on throughout the semester and kind of tied together all of the content. So as we kind of get to the end of the class, we have kind of 3 more things that we have to make sure we accomplish in the next couple of days. First and foremost, we did mention the investment committee presentations or sort of evaluations, for lack of a better word. They need to be turned in by, I think we said end of day 5 p.m. on Thursday. So please make sure you turn in the write-up for the invest committees as a team. Also, peer reviews will be due Friday at 5 p.m. And so basically the assumption is everybody gets the group grade unless you didn't feel that one or more of your team members really participated. And so for the peer reviews, basically, do it on a 0 to 100% scale. Everybody by default should be 100%. And again, 95% isn't what I'm looking for. But if everybody put in a fair amount of work, you should put in 100%. It's really if somebody did not put in their fair share or didn't do anything, that I think you should give a much lower grade than 100%. But as I said, if one team member kind of peer reviews you down, I'm not going to look at changing anybody's grades. But if 2 or more basically say you didn't participate or fully participate, then I will consider adjusting your grade for the team projects. So if need to do them regardless, and also just, can't hurt, but do a peer review of yourself and your self-participation. I think that's important as well. Hopefully it's 100%. And then finally, the final exam. The final exam was available starting earlier today. You can take it anytime between now and end of day Thursday. Again, when you take it, it's going to be a 10-question multiple choice exam, open book, open notes, just no collaboration. And it will have a 4-hour timer to complete the 10 questions, but I can't imagine anybody's going to take 4 hours to complete a 10-question multiple choice exam. Just make sure you don't start the exam and then go away, because then it will kind of auto close. And then the exam, since it's multiple choice, will kind of auto score. And then you'll be able to see the grades pretty quickly. Other than that, if I missed something, please let me know. But otherwise, grades are in. The only thing that's missing would be the final exam, which will be auto scored, and up to the 4 points, which hopefully everybody gets 4 points. But we'll see in the investment committee write-ups. Questions, comments about any of that or anything else?
I have a quick question. So you said the investment committee write-up, you're only looking for a page worth of feedback?
Correct.
Okay, thank you.
Yeah, and a kind of a 0 to 10 type of a how you thought they did.
Gotcha.
I
Thank
can't
you.
imagine with the presentations I saw, no one should be getting zeros. I mean, everyone did a pretty good job on the overall presentations. No one did poorly. From my perspective. That's I'm trying to jade your views of things, but like I said, some of these were very well done. All right, well, that brings us to the end. Well, again, it was a very short semester. Hopefully you guys learned a few things on kind of some of these, advanced modeling of companies and valuations. And we'll continue to kind of use this material, even if you're not in a finance career, and some of the principles that we talked about. And if nothing else, might even help you in some of your personal investments. So appreciate your time and efforts. And otherwise, if we don't have any other final words, we are otherwise done. And I think there's going to be a review of the class. Please make sure you fill that out as well. Always appreciate hearing the feedback.
Professor, just a
Thank
quick story regarding the write-up, the investment committee write-up. That's to be done personally, right?
It's one per team. You'll do as a
One per
team.
team.
Yeah. So it's your team doing the investment committee write-up with the other team that you were asking the Q&A for. So you're submitting it on behalf of your team, just like you did the presentations.
Excellent. Thank you.
The peer reviews are individual. Investment committee write-up is per the group.
Okay. Thank you.
All right. Well, again,
And,
anything else?
and I sent you a quick message. I don't know if I should just shoot you an email. That would be better.
Or if everybody drops off, we can chat after.
Okay. I'll hold on.
All right. We're done.
Oh, okay. Well, I just want to say thank you very much, Professor. Really enjoyed the class.
Thank you.
Bit of a, I guess, I like to do a lot of personal investing, so I really enjoyed this class and thought it was interesting. Maybe it's also because I don't like my other classes much, but I thought this class was very good, so I appreciate it. I hope you have a good time. Good rest of your fall.
Yeah, no, thanks for that feedback and good luck.
Yeah, thank you.
All right.